in the past with some of our previous seminars and webinars. Usually the 3-day seminar we like a little bit more collaboration, but because of the time limits, really, we cannot afford to be distracted by too much of a chat going on in the background. So we're just going to get things going right now. Hopefully everybody's settled, ready to go. Still a few people that haven't logged in as yet, but well, you know, you've got to be on time. Let's get going. Okay, we're giving it 10 minutes. So welcome to the L2ST webinar, Trade Execution and Trade Management online webinar. So for some of you, this is going to be a breakthrough event, and for some of you, just going to be reaffirming some of the things you already have learned through us and are continuing to learn. And you've got to remember that learning to trade is a process, and even actually the trading business itself is a process. It's a never-ending learning game, so you never stop learning in this business. Me and Brian been in the business over 10 years now, and we are continuing to learn each and every day. So it's individuals like yourself that continue to grow in this field and continue to actually succeed because you put the time and effort in to educate yourselves, and that's exactly what you need to do. Unfortunately, me and Brian just didn't have somebody that could have shared some of the stuff I'm going to be sharing with you today a few years ago. So, you know, we are basically trying to save you time and effort, and hopefully you will appreciate the information being shared today. And of course, in all other sessions, we also share with you, and also the trading room sessions each and every day. So let's get going. So the agenda for the day, for some of you, this will be actually following on from some of the stuff you may have covered originally. If you have had some form of one-on-one coaching with myself, okay, or attended one of our 3-day seminars, such as the one in October, with our events, you will realize that we always continue to expand on the knowledge that we share, because we always grow as traders, and we always continue to learn more and more each and every day. So even if you did attend, you know, pay close attention. There'll be some things which you may have heard before, or may have listened to, should I say, but may not have necessarily actually understood. Okay, so I'm always talking about the repetition of recognition, okay, or repetition is key in this business, and repetition is key in any field where you have to learn. So, you know, sometimes you'll know that, you know, going through certain seminars or webinars that you may have attended in the past, you know, a few years down the line, maybe you've read some books or whatever, you come back to them, you know, a few months down the line, a couple of years down the line, it always makes more sense. So even if you've heard some of this before, listen to it again, and let it just build upon your understanding that you already have. So that's one of the things that we continue to do, and me and Brian always experience it ourselves. We go back to even some things we share with you guys, you know, 2 or 3 years down the line, we go back to it and say, you know, this stuff is still valid, you know, but we now understand it even better through our experience. So just important to just understand that some of the things you'll hear, they will make more sense now that you've had maybe a little bit more experience from the coaching sessions that you may have had one-on-one, or maybe even the 3-day seminars. For those of you that haven't attended the 3-day seminars, or had some sort of one-on-one coaching with us, a lot of this will be new to you, and you hear us using these techniques in the trading room all the time, but yet maybe you haven't yet understood exactly why we're doing it and what we're trying to do. Okay, so for you, it's going to be even more beneficial to make sure you definitely keep your eyes open and your ears open, and make sure you listen. With any one of our events, we always make sure that we understand that everybody learns in a slightly different way. Some people are a little bit more visual, some people a little bit more auditory, some people a little bit more kinesthetic, and I totally understand that, being a NLP practitioner myself. So one thing that I do make sure with my presentations is make sure that you not only see what you're learning, you hear it, but you also feel it. Okay, so hopefully at the end of the day, you will learn something new. Right, okay, so today the agenda is understanding pre-trade and post-trade supply and demand. You have to understand the difference. I'm always talking about pre-trade and post-trade supply and demand. So if you haven't yet understood what I'm talking about and what that means, you will understand that today. So we would then break down into reading pre-trade supply and demand a little bit more so, reading and understanding the order book. I'm not going to spend too much time on the order book because I feel as new traders or traders that are beginning to just understand order flow, you don't really need to focus too much on pre-trade supply and demand. You need to understand what it is and why it's there. But most of the execution skills that you will develop and the trade management skills you will develop will be based upon the factual information, which is the post-trade supply and demand. That is actually in the market right now, okay, and actually being traded. So what we were focused on is reading the time and sales, as you guys sometimes seem to bring that into the trading room. So we're focused a little bit on reading the time and sales, the sort of things you need to be looking for and why you need to be looking for it. The market data footprints, obviously a commonly used tool in our trading room over the last couple of years or so, and it's been a beneficial tool for us and has made a massive improvement, and it continues to do so. Make massive improvements on our trading. So that's what we're going to spend a bit more time on, market data footprints, because that is really the software package that we should all be using right now, and making use of the software and the information that it provides, because it's giving us a massive edge. So make use of it while you can. We're also going to look at the different footprint styles, the bid ask and the delta footprints. That's classically the ones we would use. Trading and executing off the footprint, the sort of things you should be looking for. The footprint patterns and setups. Basically, they're not complicated. They are complicated for somebody that maybe don't understand them, but for the guys that do just begin to understand some of the setups that I've broken down here, it becomes quite easy to look for it and actually pull the trigger off it. Then we also look a little bit at the psychology of fear, at the fear of pulling the trigger. Okay, I get a lot of emails from not only new traders but professional traders. Some big traders that are working for hedge funds, prop firms, investment banks, and I help them with all sorts of emotional trading habits that they may have picked up, and also limiting beliefs, etc. One of the classic things that we always come across is the fear of pulling the trigger, or the hesitation that occurs once you see everything is lining up and you just fail to pull the trigger and you just watch your trades go by one. So I'm going to share with you some ideas on how to deal with that, because that is a massive part of trade execution. It's not just about understanding the technicals and what you need to be looking for. It's also about obviously pulling the trigger, right? So pulling the trigger is the main part. And some of that, is quite simple, to be honest, but you may have not heard it before because nobody really shares this information. And we want to be a little bit different at L2SD and be a little bit different from the norm, not only in our own trading, but also a little bit different in how we teach you guys and the information that we share. And we want to stand out from the rest. It's all about thinking different and stepping out of the box and thinking out of the box. And this is how you make it in this business, not only in this business, in any business. Okay, you have to be creative. You have to think out of the box. You have to be a little bit different. And what I would recommend you guys start to do is understand why maybe we are a little bit different and we do things a little bit different to the norm, and maybe different to maybe what you have learned. Okay, and I always say approach our training seminars and coaching sessions with an open mind. Forget about what you know for a minute, if you could, or even at least for the next 3 hours, and you could always pick it up later if you need to. Just for now, just imagine that you don't know what I'm going to talk about, right? So the other thing we're also going to talk about is trade management, which is obviously where the actual results occur. The importance of outstanding trade management will be discussed, and the key trade management focus that we should all be looking at, which most traders don't, and also ways of minimizing risk and maximizing profits. And some of you will also learn some new things there in terms of minimizing risk, because it will be a little bit different to the norm. And most of our presentations are a little bit different to the norm, because what you realize is we probably share the 5% of the information that most people don't hear, and that's why only 5% of the traders in this business actually make it. Okay, 95% of the information out there is bullshit. Okay, and the sooner you realize that, the better. So somebody's got to be out there to show you the truth, and me and Brian are here to do exactly that. So understand why we're here and understand why you're here, to finally realize the truth. So let's move on. Hopefully that sounds okay. If there's any problems with the visuals or sound, please let me know. Right, quick disclaimer, usual stuff that we have to do. Basically, it states that trading involves risk and money can be made and both lost. And basically, you can read this in your own time. You know, everybody's seen the disclaimer once or twice in their time, so we won't waste the time there. Right, let's move straight into this. So why are we actually going to look at order flow? Why are we going to even focus at looking at trade execution? Well, firstly, you've got to understand that this is a part of our game plan. For you guys that are new to the L2SD game plan, we actually have 5 steps. And I broke down these 5 steps simply by opening up my mindset and asking myself, what do I think about, or what do I go through? What is my thought process? You know, when I'm thinking, when I'm looking at a trade. Now, what is it that I'm looking for? Now, one of the things we always have to understand is step 1, understand structure. Step 2, okay, is all about understanding or identifying the opportunity. Step 3 is all about risk to reward. Now, what we're going to focus on a little bit more today is step 4 and 5, which is trade execution and trade management. And most of us will actually find that most of the information out there, most of the books you'll read, is focused more so on maybe steps 1 to 3. Identifying, you know, understanding a little bit about the market, probably not so much on step 1, but maybe step 2, identifying a setup, okay, a certain trigger, maybe, and then maybe step 3, which has become a little bit more of a buzzword these days, risk to reward, and looking at risk management. But a massive part of it is step 1 and step 4 and 5, which is usually it's the bracket for your trading mindset, which is usually forgotten about, and most educational firms and most traders sort of focus on, you know, step 2 and 3, and usually step 2 more than anything. And step 2 is probably the weakest part, and probably the part that you all need to focus least on. And you know, it's no surprise that most traders fail in this business, because that's where everyone focuses on, you know, step 2, which is the triggers, the setups, you know, what settings that I should use for my buy setup, what settings I should use for my sell setup. All of this stuff is bullshit. You know, you guys got to move on from that. Focus a little bit on understanding structure. Focus a little bit on understanding what your competition is all about, what they're trying to do. Understand the business very well. Understand your competition, because you know, that's who you're up against. You're up against some real pros who are ready to take your money if you're willing to give it to them. So our job is to basically save you a little bit of dosh, save you from giving these guys their money, okay, and taking a little bit of theirs, right? So if you want to learn how to do that, stick with L2SD. That's all I can say. Okay, it might take a little bit of time. You know, we're not going to promise you a weekend seminar and you're going to make millions in the next day, okay, or in the next week, or even the next month. What we're going to say is, if you work hard at this and you put some time and effort into this, and you actually master each step by step, you're going to make it in this business, as long as you believe in yourself. Okay, so that's what you've got to understand. So one of the things we're going to be focusing on today is step 4 and 5, okay, of our game plan. So I understand this is a part of our game plan, but it's one of the most important steps, or should I say 2 of the most important steps of our game plan, which is the importance of confirming trades with order flow, and also obviously the trade management. Okay, so the importance of confirming trades with order flow. Once you have a good understanding of structure and the setups you will trade, the next step is to master execution and trade management. Okay, this is going to be our focus for today. Most traders will have a very good understanding of the setups they're looking for. They will have a good understanding of the buy and sell triggers. Maybe they're looking at some mechanical system. Now, we quite simply just look at areas where we're looking for buyers and sellers, and we look for evidence behind that with some of the order flow information that I'm going to be talking about today. It's not rocket science. It's very simple. Okay, it's just a little bit difficult for some traders to understand, because they've never really heard it told the way it should be told. Okay, so this is what I'm going to share with you. I mean, I've worked alongside some big traders, you know, easily making, you know, 20, 30, 50 grand a day. Okay, and some of these traders, no problem losing 10, 5 grand a day. Okay, so I I have picked up some stuff from them, and they picked up some stuff from me. And where I'm coming from experience, and I'm coming from a place where I've seen guys making money in this business for many, many years, okay, and continue to do so. And Brian and me are one of those guys, okay, or two of those guys, should I say, okay, and we are here to share the information that we can share from our experience more than anything else. It's not stuff that you will learn from books, not stuff that you will probably be able to Google and hear much about, stuff which you could probably only get from professionals that are making money in this business. And I'll tell you what, most of them are not going to share this information unless you know them personally. Okay, and even some of those guys will hold back on the information. Luckily, we're in a good position, okay, and we've come across some good guys, and a lot of this has been learned through our own experiences. But we always take everything that we learn and hear with a pinch of salt, and we never take it as a solid belief until we make it our experience and actually see it for being our reality. Okay, so that's what I want you guys to do. Okay, so let's carry on. So what you'll find is a lot of traders, and maybe some of you will be able to identify with this, is that they lack the understanding of the importance of timing and execution skills, okay, when trading. Unfortunately for most traders, by the time they realize this, it's usually too late. Okay, better trade execution is gained by focusing on the reading of order flow, because that's why we focus on it. That's why I always talk about order flow. Okay, now you can trade without it, don't get me wrong, but the thing is, you will never have as good a results as somebody that's trading with it. Okay, so that means that your competition is always going to have an edge over you, and that's not what you want in this business. Okay, you're going in for a battle. You need to win that battle each and every day. So if somebody's using something that you're not using and you don't yet understand, make sure you understand it and begin to use it. And if you don't, okay, they will always walk over you. Okay, they will take advantage of your lack of knowledge, your lack of understanding. So this is why we're going to focus on order flow. Forget about setups, forget about all these breakout trades and chart patterns, etc. Okay, structure is a very important thing about what we do, but forget about that stuff for a moment. Okay, all you need is a simple buy setup, a simple sell setup. It might even be as simple as a moving average crossover, right? If you follow that with order flow, it will work. Okay, all you got to do is trust me, try it out for yourself. Okay, what we're going to discuss is about order flow today. Okay, a few good tools are available that enable you to do this successfully. Okay, but you have to know how to use this. You have to know how to use it. Otherwise, they can work against you. So this is another important step, because a lot of traders, what they do is learn a little bit about reading order flow. They learn a little bit about time sales, learn a little bit about the order book, maybe learn a little bit about market delta. Okay, now I made this mistake myself when I started looking at market delta footprints. I listened to a few videos, buyers lifting the offer, sellers hitting the bid on Market Delta's website. I took that information and I thought, that was God. So I followed it, okay? But through my experience, I learned there's certain things that don't quite work, okay, in certain places. So this is what you have to be aware of, okay? So, the theory is all good, but practical experience is always going to outweigh the theory in any business, in any topic or whatever you may do. Okay, the experience is always going to outweigh that. So what we're going to share with you, and what I want to share with you today, is more about the experience and what I've learned, what works and what doesn't work. Okay, so save you some time and save you a lot of effort. So remember that I talked about setups. Setups are only that, okay? They're a trade setup. You have a trigger to buy, you have a trigger to sell. It's only a setup. It just means that there's a possibility buyers may come in. There's a possibility that sellers may come in. Okay, one of the things we're going to get with order flow is evidence. Okay, setups alone are not reasons for entry. Some trade setups are better left alone, and some maybe must be taken without hesitation and precise timing. One of the things that I've learned through, focusing a little bit more on trade execution and trade management, and making that my main focus, my profits increase massively. Okay, I mean, almost, I would say, double or tripled on a yearly basis. So that's how much of a difference it makes, and that's why I'm a big believer in reading order flow. No, I'm not saying you can't make money without it. I'm saying you can make a lot more money with it. Okay, and you'll have a much better chance of succeeding in this business if you use it. That's what I'm trying to say. So don't get me wrong. There's nothing wrong with just using a price chart and a candlestick chart and market profile, whatever it may be, or a trading system, as long as you follow it. Okay, one of the most important things you'll understand, though, if you don't use order flow, you're going to have bigger drawdowns. One thing that I've learned is by using order flow, I have gained a much better edge. I understand not only when to get out of trades, I know when to get out of them a lot more quicker. So therefore, it means I will suffer smaller drawdowns. And smaller drawdowns, you have a much better chance of making update after update. Okay, meaning that you really don't have a down day. I can quite confidently say, not straight away, okay, I'll admit, after using order flow and understanding it so well, I did have some down days, but my down days are always kept small because I have a risk management plan that keeps my days small, my losing days small. But I would say, since focusing a little bit more on order flow, my drawdowns have become a thing of the past. They no longer exist, because when you start to really understand and master order flow, there's no way they can. And that's the beauty of it. And that is the beauty of it. And someday, most of you guys will begin to see this. Reading the order flow behind a trade setup gives you one great thing, and that is evidence. And when you have evidence behind something, okay, that means there is conviction behind the opportunity that you've just defined. So if you see a buy setup and there's evidence that buyers are actually coming in, okay, and lifting the offers, you've got evidence. Okay, but if you just get a buy setup with no evidence, it's just a buy setup. All it is a line or a crossover on a chart. Okay, maybe a green bar or a red bar, maybe even a green arrow or a red arrow. Doesn't matter. That's all it is. Okay, the fact of the matter is, a green arrow, a green bar, a red arrow, or a red bar is not going to move the market. Okay, professional traders that make money in this business don't look at colors. I can tell you that right now. They look at one thing and one thing only. That is, who's buying, who's selling, and if so, with what conviction. And that is why you need to shift your mindset in order to start thinking this way. Right. Any questions so far? Continue then. Okay, some of you may have seen this before. Okay, so you guys have to understand there's two different kinds of supply and demand. Everybody understands supply and demand. You come across it each and every day. You know, each and every day, whenever you look at buying something or selling something, you come across it in the high street all the time. The market is nothing but an auction. You have to understand that. Okay, so you have to understand how the auction works. Okay, we've got an unrelated question here, but yes, the event will be recorded, Naz. So for anybody that doesn't miss it, or sorry, does miss it, okay, or misses parts, or wants to review, you can catch a recording. Okay, I did state that in the email, so in case anybody missed it, it is being recorded. Anyway, let's move on. That's the least of your issues right now. Let's look at resting pre-trade supply and demand. Okay, what is pre-trade supply? Now, you guys will hear me talk about pre-trade supply, pre-trade demand, and post-trade supply and demand. Okay. Now, what is pre-trade supply? It is exactly what it says. Okay, let's not complicate the matter. It's It's supply and demand that is pre-trade. It exists before trade, right? So it's the volume of resting orders. Okay, so pre-trade supply is the volume of resting offers that are available at each price or at the current offer and above. So you'll always have a current bid and offer price, okay, but the current offer and above, okay, not yet filled. So any resting orders at the current offer and above but not yet filled, okay, these are the orders that exist as either supply to the current buyers that are willing to lift the offer or cut off their demand. Okay, so these orders as pre-trade supply and demand, okay, they exist either to supply, okay, or to cut off. So in terms of pre-trade supply, it exists to either supply to the current buyers, because if somebody wants to buy, now if I have 2 apples and Brian wants to buy 2 apples, he needs somebody that's going to offer it to him, right? So I will have the resting offer there for him to buy it. Does that make sense? Yes? Very simple stuff, but you'll be surprised how many traders don't understand this. Okay? Now, the other thing is pre-trade demand, the volume of resting bids that are available at each price, or at the current bid or below. They're not yet filled, they're available. Get the orders that are available, so that's why they're pre-trade. They're available but not yet filled. Okay? If somebody wants to sell, there's got to be something to buy, right? If somebody wants to buy, there's got to be something to sell. Somebody's got to be selling to the buyer, and somebody has to be buying from the seller, right? That's why there's pre-trade supply and demand. And then the post-trade supply and demand is what we're going to look at next. So these resting orders, what we call pre-trade demand, exist as demand to cut off the current sellers. So if the market is selling off and sellers are hitting the bids, okay, all of a sudden they're going to come into some support. Yeah, exactly. Yes, Georgie, pre-trade demand is below the current price. So you'll always have 2 prices that are being traded right now. One of the 2 are always going to be traded, the bid or the offer. The market is always going to be going bid, offer, bid, offer. Some people say ask, I like to say offer. Bid, ask, okay? So you'll always have the last trade price, you'll have the bid price, and you have the ask price, right? So the last trade price is the one that is actually being traded. So, you know, if we're trading the bid, the sellers are hitting the bid, okay, but they're buying from the buyers that have resting orders on the bid. So if you put a limit order in on the bid, a seller has to take or hit your bid in order for it to get filled, right? If you have an offer in the market, meaning a limit order to sell the market, you won't get filled until a buyer comes to the offer and lifts your offer, right? So that's what you have to understand about pre-trade supply and demand. Now, what we're going to quite simply look at is this will explain it a little bit further. Now, some of you guys that have been on the coaching program or 3-day seminar obviously have a little bit of a more in-depth understanding of this, but some of you guys may recognize some of this from the coaching program. Right, so what we generally use to read pre-trade supply and demand is we can use the time of sales, but generally what is used by most traders is the DOM, okay, or depth of market, okay. It's usually called the DOM or DOME or the depth of the market, okay. A typical trading platform would display usually a depth of 10 prices, okay, meaning 5 at the bid and below, okay, and 5 at the offer and above. The numbers on the right column, okay, so you have the price in the middle column, and then you have the left column is usually the bids, the right column is usually the offers. Okay, so in this case, if you look at this example, 1025.75 is the current bid. 1026 even is the current offer. Okay, the numbers on the right column display the resting offers, okay, in the red column, but they are just resting orders. They haven't yet been filled. So if you want to buy 1026s, you know there's 387 that offer. So if you wanted to buy 400, you probably won't get filled unless somebody puts some more limit orders in. Does that make sense? If you wanted to sell 1,000 at 125.75, you probably won't get filled, okay, because they're not available yet. Okay, but you know these buyers are obviously going to be getting filled with their limit orders on the bid and the offer. But if you're going to hit the bid, you're going to hit their bids. If you're going to lift the offer, okay, you're going to lift those offers. right? So a buyer willing to lift the offer or going at market will lift these offers at 126s. A seller looking to hit the bid and go in that market will hit these bids, okay, at 125.75. Okay, so the price column is in the middle. Remember that the market works arresting orders depending on where the market orders wish to trade. So sellers hitting the bid with more volume, okay, we would go bid. If buyers are lifting the offer with more volume, we would go offer. So the market's only going to be trading the bid of the offer. It's either going to go bid, it's going to go offer, it's going to go bid, or it's going to go offer. Where it generally pulls to, there's a gravitational pull, where it pulls to is where most volume is. If more buyers are lifting the offers, the market will go offer. Okay, because the job of any market is to facilitate trade. Doesn't matter what you're trading. Doesn't matter if you're trading gold, silver. Doesn't matter if you're trading oil, the Dow Jones, the S&P, the Euro stocks, the Euro bonds. It doesn't matter. What matters is where trade facilitation is. So wherever the supply and demand is coming in, that is where we will trade. If there's more sellers hitting the bids, we will go bid. If more buyers lifting the offers, we will go offer. Okay, until those offers are depleted. So the offers that are resting, if they're depleted, so the 387 despairs at 126, and there's maybe 1,000, but we have to go 126 quarter in order to find some more sellers willing to supply to the demand that's on the table, okay, that's coming into the market, right? Does everybody understand that? Very important that you understand this very simple concept. This is the way the markets facilitate trade. Okay, so the market will always work the bid of the offer, and it will go wherever the volume is. The job of the market, any market, as I said, is to facilitate trade. So, you know, if there's not enough on offer at 126s, we will go offer at 126 quarter. Then we lift the offers there. If there's so much demand coming into the market, buyers lifting the offers, then we will go and lift the offers at 26 halves. Okay, until those 877 have been depleted. Okay, but you know, 126.75 is quite a bit on the offer there. So if we get to 126.75 and maybe only 500 lift the offer, that means there's not enough buyers to lift the offers to get through 126.75. So that then becomes resistance, right? And obviously vice versa. If the sellers are hitting into the bids and all of a sudden there's not enough sellers willing to hit the bids aggressively enough to get through the resting orders at maybe 125s, that will become support. So the market will always go bid on a low and always go offer on a high. Okay, so guys that don't really understand how order flow works may actually even get tempted to buy the buyers lifting the offers into a high or sell into the sellers hitting the bids on a low. One of the massive reasons we don't trade breakouts is because this system is designed, if you understand trade facilitation, it is actually designed in order to make breakout traders foul. And you'll understand why we don't trade breakouts when you understand how order flow works. Because buyers will always lift the offer into a high. Sellers will always hit the bids into a low. But that is why you never want to go with that information into a high or a low. And I want to talk about that. Take that information in. I'll give you a few seconds to fill, hear, and see. Good. Let's move on. Now, arresting free trade supply and demand. What is that all about? Well, it's actually orders that are in the market and actually being traded. This is what you see on the time of sales. This is what you see on your footprints. Okay? Post-trade supply. I often call it post-trade supply because it's happened. Post-trade demand. Why do I call it post-trade demand? Because it's happened. It's now factual. It's real. You cannot ignore this information when it's factual. It's in the market right now. That's why we use this more so than anything else. And that's why our focus is going to be on post-trade supply and demand more than anything else. Now, I do use pre-trade supply and demand, but I feel it's way beyond the scope of this presentation. And maybe the next presentation that we'll do, we'll focus a little bit more on resting orders on the bid and the offer. But for you guys to start using this information and start really getting an edge focus a little bit more on the information I'm going to show today, and you'll have a massive edge. It will make a massive difference if you understand it well enough and master it. Okay, if you understand it just a little bit, as I said, it might work against you. But if you understand it fully and master it first and then start to use it, it will work massively in your favor. So there's a massive difference between just learning something and knowing a little bit about it and mastery. And what you want to do with each and every concept that you learn in trading is mastery. Okay, if you just understand a little bit about it, leave it. Don't even bother thinking about using it in your trading, especially with a live account. Unless you sim trade it consistently, whether it takes 2-3 months, whether it takes 2 or 3 years, doesn't matter. Do whatever it takes. Okay, one thing I'm never going to promise you is that this is going to happen overnight. And if anybody does, run for the hills. Okay, me and Brian are only here to share one thing, and that's the truth. Okay, and I'm telling you right now, don't expect to get any of this even just today. Make sure you practice it again and again and again until you master it. Because unless you're a master in the concept, you cannot yet use it, because otherwise somebody will use it against you. Okay, so make sure you understand that concept. I tell people this all the time, and they don't listen. And all I'm trying to share with you is good advice. Please trust me. Please trust Brian. We share with this with good intentions. That's all. Okay? So, let's move on. So, post-trade supply, what is it? It's the volume of contracts actually sold on the current bid in order to fulfill the resting demand, or behaviorally in order to enforce or initiate a downward price move, okay, or downward move in price. Now, what is post-trade demand? It's the volume of contracts actually bought on the current offer in order to fulfill the resting offers, or behaviorally in order to enforce initiate an upward move in price. Now, these are the guys that have enough volume to move the market. Now, some of us may have enough money to do that. It only takes one trader with enough orders to come into the market that actually cause other traders to think differently. Now, if you have the size, you can put a 1,000 lot, 2,000 lot in right now. You can enforce your belief or your perception of the market onto others. Not many people will tell you that, because most traders that trade this business, okay, don't actually understand order flow. So they won't actually understand that if I put an offer in that's high enough, somebody might actually use that information. But the professionals, such as those flippers, okay, that you may see quite heavily a lot on the interest rate derivatives, okay, and more commonly on many more other markets now. Okay, you can see their trades coming in on the bids and offers on the order book. When you understand these guys and you trade with them and you know them and they're your friends, you know how they work. Okay. Now, I don't play these games myself, but I could. Okay, but I use them, the guys that play these games, and take advantage of the small boys. Okay, they don't understand this information. I use them. I use what they're doing in order to take advantage of the small person. Okay, may sound a bit harsh, but this business is harsh. For every winner, there's a loser. For every loser, there's a winner. Okay, but one of the things me and Brian do to make up for that is help out the small guy, make them understand this information. You know, maybe some of you big guys that are in the room as well. I don't know. You know, I don't know where you are, but anyway, it can help you whether you're small or big. Doesn't matter, right? So the main thing is you understand the information, you use it. It doesn't matter how big you're trading or small you're trading. The fact of the matter is, this stuff moves the market. This is what guys that make money in this business look at, and they follow each and every day. So the sooner you realize it, the better. You know, I have many traders that end up going into learning from these so-called #1 trading firms in the UK and the US and whatever, right? Usually the guys that you hear about in that way, you know, very good marketing, very shit trading. That's basically what it comes down to. So what you've got to understand is that, you know, you've got to go to, you know, the stuff that which you don't usually hear that much. You know, I will continue to say that because it's the truth and I know it. Okay, it's just a matter of, you obviously beginning to know it and understand it for yourself. Okay, so one of the things you got to understand as traders, okay, you got to start looking. I mean, I focus at tick by tick, okay, because I understand that all it takes is one trade, okay, one tick, one trader to turn around the market maybe for 100 ticks, okay. That's all it takes. Now, if you don't understand this, okay, you better begin to understand it, because that's all it takes. So one thing that you'll hear again and again and again, but you've got to understand why it is the fact, is that trading is a zero-sum game. For every buyer there is a seller. For every seller there is a buyer. And at every price that at every price that trades, this is the case. Okay, so we're trading 1030s right now. There's going to be as many buyers as many sellers. Okay, so in fact, when you say there's more buyers than sellers, and that's why the market's moving higher, or there's more sellers than buyers, that's why the market's moving lower, is actually not true. Because the fact of the matter is, there's actually a seller for every buyer, and there's a buyer for every seller. Because how could a buyer buy without a seller? And how could a seller sell without a buyer? It just doesn't happen. Okay? So, what you're going to understand is that who wins at it, overall at each price, okay, is determined by the side that has the most volume. That's why we follow volume at price. Okay, the side that has the most volume is who wins. If buyers are aggressively willing enough, okay, to lift the current offers, this will be displayed by higher volume traded on the offer. That's why we look at the offer, okay, the data on the offer, or compare the bid to the offer when we look at the footprints. If you guys haven't yet understood the footprints, we're going to discuss that and explain what we look for. If sellers are aggressive and willing enough to hit the current bids, this will be displayed by higher volume traded on the bid. Okay? The key is to watch for follow through when you see this. There may be some sellers hitting the bids, then you might actually not get any follow through. The market may not actually drop down or even down tick. Okay? The buyers might lift the offers, but the buyers may not actually be able to uptick. Okay? So the key is to watch for follow through, and when decent sizes are traded on the bid and the offer. So look for this. You have to understand what size moves your market. Right? Now, quick show of hands. Who actually understands this information very well? Okay? Now, obviously, some of you guys in the training room understand this stuff very well, but maybe it's probably a better question, who doesn't understand it? Okay, who doesn't understand pre-trade supply and demand? Just give me a quick show of hands. That's good. Most of you guys understand it at least a little bit. Okay, some of you are still understanding or needing to master it a little bit more. For some of you guys that are new to this, okay, maybe review the presentation, and some of it will sort of build upon what you've just heard about, okay, because we want to show you how to look for it, okay, in coming slides. Right. So, what I would say is, first of all, begin to make this a major focus of yours, okay? Make it a major focus to understand how the markets are actually moving, because what we're talking about here in terms of order flow is how the markets move. So some of you may have read books or been to presentations or been on seminars and have understood certain price patterns or certain indicators or certain setups, okay, but not yet understood why they work. And this is really about understanding why certain things happen. And because if you understand much better how things happen and why they happen, okay, you're in a much better position to trade, full stop. And if you're going to be in this business and you're really serious about it, it makes sense to understand it, right? So one thing I want to give you a warning about, okay, key thing to remember is when you're looking for sellers, okay, key thing is to remember that you're looking for sellers at key selling price levels. So you have to have understood step one of our game plan, understand why we're looking for buyers and sellers where we are, okay? And the other thing you got to understand is that if you're looking for buyers, you've got to be looking for buyers at key buying price levels where you're expecting buyers. Okay, looking for sellers hitting the bids at swing highs into resistance. So you've got to have an idea where you're looking for sellers before you start looking for the order flow. Look for buyers. Sorry, you're about to throw. Look for buyers lifting the offers at the swing lows into support. Okay, so when the market makes a swing low, look for the buyer start lifting the offer. Okay, do not go with the breakouts with this info. Okay, as the reason why is because what may appear as sellers hitting the bids into support may actually become resting orders to buy, cutting off the selling activity. Okay, meaning that you may actually see more volume showing up as on the bid, okay, on the footprints, for example, as traded, or on the time and sales. But if you're coming into a key support level and you see more volume on the bid, okay, it could be buyers putting in orders or limit orders, okay, just as you could below value or at support to buy the market in order to cut off that supply which is hitting the bids, right? So understand that, you know, the information that you're looking at is basically the information that you could actually provide as well to the market. If you put a limit order in to sell 10 or buy 10, okay, buy 10 at the bid, it's going to show up on your order book. If you put an offer in to sell 10 at the offer, it's going to show up on your order book. Anybody can put 100 lot in and pull it, or 1,000 lot and pull it, so it might not be real, okay? But what is factual information is what's going to lift the offer, what's actually going to trade those offers, lift those offers. But if the buyers lift the offers, the market will move higher, okay? If sellers are hitting the bids, the market will move lower, especially off key support or resistance. But if you're coming into support, sellers are hitting the bids, that could actually be shown as buyers also with resting orders on the bid. So that's one thing you have to be careful with when you're watching post-trade supply and demand. Okay, so sometimes you'll see a lot of selling on the bid, okay, which might look like sellers hitting the bid, but you've got to understand there's two sides of the game here. Some of the bids that you're seeing there may be actually bids that are actually being filled for buying this market. That's why the market always gets cut off on the bid when it makes a low, and it always gets cut off on the offer when it makes a high. And if you look at the footprints, you'll often see there's 0 on the bid and some volume on the offer on a swing high, and there's usually 0 on the offer, okay, and some volume on the bid when you make a new low. Okay, so this is some of the things that some of the traders that just take a little bit of this information away and don't understand it well enough get caught up with. They're selling into the bids and thinking, oh, there's more volume hitting the bid. Why didn't the market go lower? Okay, it's because you're not yet knowledgeable enough to understand why. That's simply why. And so this here, what I'm saying, is to make sure that you're knowledgeable enough to understand why you'll see sellers hitting the bid into a low and the market bottoms out. But the key thing is to look for a swing high and then look for sellers to hit the bid. Look for a swing low and support to hit and then buyers to lift the offer. That's the key thing you got to remember. Does that make sense? Good. Right, guys, we're at 8 o'clock now. We're going to have a quick 5-minute break and we'll continue with the presentation. Hopefully you guys have learned something a little bit so far. Let's have a look at some of the tools that we can use to read post-trade supply and demand. Right, the two tools we usually use, okay, to read post-trade supply and demand. I'd say more traditionally we use time of sales, but more so now we use market order footprints. I still like to use the time of sales, mainly because it shows more of, I'd say, market order footprints provide price transparency, but time of sales shows even further transparency in order to understand from a trade by trade basis what is actually going on. And as I said, all it takes is one trader, to put in some good size and then some other traders to see that and then follow on from that. No one trades, no one that really makes any decent money in this business, okay, trades purely off a chart, okay, meaning a price pattern, meaning market profile, and all of these potential holy grail, tools that are available. Market profile, is good, but it's not great. It's not the be all and end all. Okay, I mean, market profile is good. It's given us one great thing for me and Brian. I think there's still a lot of traders that think there's more to it, but more importantly for us, me and Brian, and for most professionals that make money, the most important thing is price patterns and where the expectancy and understanding of structure. But market profile is good for one thing, understanding where value is and where price is and how the market profile is unfolding. But for us, in practical terms, if you want to trade off anything, use a combination of price and value relationships with order flow. That's exactly what the L2SD Art of Adaptive Trading plan is all about. We've taken the best of the best and put it together and made a system. We've made a methodology, and it's just a matter of understanding that. Trade execution, trade management is part of it, but you can only use that in line with some form of understanding of what is happening in the marketplace, why you should be looking for buyers and sellers. You can't just move to a market or a footprint, look at time of sales, and say, look, there's more sellers, let me get short. There's more buyers, let me get long. You can't do that. You have to look at it in context of what's happening in the marketplace. Okay, so that's why it only makes up step 4 and 5 of our game plan. So the first thing we're going to look at is time of sales. Okay, it basically shows you the individual trades actually filled at the current bid and offer, whereas the order book shows you the resting orders on the bid and the offer, what's available, in order for you to sell into, what's available in order for you to buy into. But, or maybe, you put a limit order in on the offer or the bid, and you become a part of that resting or pre-trade supply and demand. But most traders that want to get in the market right now and seen an opportunity, they want to get filled. Okay, so that's why we call them aggressive. They've seen a shorting opportunity. They've seen the market set up a short. They want to get in the market. They want to get filled right now. Okay, and their behavior being aggressive is what's going to move the market. Usually passive traders, a little bit, they're waiting for the market to come to them. Okay, and you yourself can put a limit order in. It doesn't matter. That's an execution method. But most traders that want to get in the market right now and really want to enforce their opinion on the market will hit the bids or lift the offers. Okay, even those that will put a limit order in on the offer or put a limit order on the bid will usually work in the rest of their trades by lifting offers or hitting the bids. I mean, that's what I do, and I know that's what most professionals that make money do. Okay, so that's the way they work. So understand it and, just use it. So the other thing we'll look at is market data footprints. Okay, this accumulates this information from the time of sales and makes it more easily readable and digestible by actually displaying the sellers hitting the bid or lifting the offers at each price. So you can actually see how it's accumulating at each price as the price is trading. Okay, so we display this information in terms of market data footprints. So it's a big breakthrough for a lot of traders that understand it and know how to use it. It's relatively new to the trading game or to the trading business. Even for those traders that do consistently use order flow, it's basically turning around the business, right? And you guys are in a good place right now. If you can understand the market data footprints and master it, you're in a good place right now. Okay, as with any business, if you get into it at the right time, at the right place, you can make it work for you massively. And all I can say is market data footprints, it's a tool that's not been available for that long. Now, if you can master this in the way me and Brian have began to do this and actually share with you guys, you can see, if you guys haven't been in our trading room yet, you will see on a daily basis how we use this information, okay, to really get a massive edge. And if you haven't yet begun to understand it fully, maybe you've just seen us doing it and not yet able to actually do it for yourself, it will come over time. Okay, just be patient, believe in yourself. Me and Brian totally believe in you, so there's no reason why you shouldn't believe in yourself. So make sure you believe in yourself and don't give up, and just make sure you stick with it, because if you can get this right now, let me tell you, if it takes 2 or 3 months, you're still in a good place to make it work for yourself. Okay, whether it, for me personally, I don't think there's many people using it, and even if they do start using it, okay, it's only going to work in your favor. Now, a lot of traders say, if you have a secret, don't share it, okay, because it's only a matter of time before it starts working against you. I totally believe against that, because if you understand order flow, if more people are doing what you're doing because they're looking at the same thing, what that means is more volume on your side. If there's more volume on my side doing what I'm doing, lifting the offers, the market's more likely to go in my favor. So the more people understanding what I'm doing and why I'm doing it, the better for me. So that's why we also do what we do. So, as I said, in our trading game, I want people to succeed in this business, not only because I want to succeed, but also because I want you to succeed. But and I've got no problem with people doing the same thing as me. Okay, I've got no problem with people doing the same thing with me as me. Okay, and for me, it's all to flow in my direction. Okay. One thing, I'm not as selfish, Chris. We're totally not. One of the things we do is share this, obviously, for a reason, because we want people to succeed, and there's not enough people out there sharing the truth. And the fact of the matter is, we've got no reason not to share it, because more volume doing the same thing as us is a better thing, not a bad thing. So we don't have the Lord of the Ring syndrome at all. So use this information while you can, and use it for yourself. Make it work for you right now, because it's a good time to make it work for you. Okay. Okay, I've got a question about cumulative delta here from Sean Hummel. I've been learning about this from another trader who believes that you can add it to show buying and selling conviction, but I'm still not convinced. Okay, well, cumulative delta is basically looking at the cumulative delta for the day. Okay, so understanding that for the day will give you some sort of bias, however you want to pronounce it. Okay, for the buyers that lift the offers, or sellers that hit the bids for the day, but it's got no real conviction as in what's going to happen next for you to take a trade off. Might give you an idea of what's been happening, okay, but the thing is, when you're trading order flow, you're coming from the perspective of what's happening right now in this present moment, and you have to, okay, because what's happened in the past is obviously a guideline, okay, and that's all it is. But if it's going to change in this moment right now, okay, not even in this second, in this millisecond, okay, if somebody is showing us otherwise, we'll go against it. So I would say with order flow, it's more about what's happening right now, more than what's accumulated or accumulated for the day. That might give you sentiment or a bias, okay? But a bias or sentiment is just that. It's not a reason to execute a trade or anything. We have better ways to do that anyway. And what we look at order flow for is more so evidence behind a trade setup once you've got the setup and a reason to get into a trade. Okay, so we do look at delta at price rather than delta for the day. Okay, so we look at cumulative delta at each price as it's trading. Okay, which we're going to talk about. So let's move on. So time and sales, it's not difficult. You don't need to complicate any of this. Just keep it simple. Best way with anything when you're first learning it, you can always add more to it as you go on. Okay, with the time and sales, basically, I'll talk about this in the trading room all the time. Okay, floods of selling or floods of buying. Okay, usually that drives the market off a particular trade setup. Now, before market data footprints, this is exactly what we used. We look for selling floods in order to execute shorts. We look for buying floods in order to execute longs. There's no point getting short if you can't see any evidence that sellers are hitting the bids. There's no point executing a long if you can't see any evidence that buyers are lifting the offers. Okay, now this is going to change from a tick-by-tick basis. It's going to change relatively quickly. Sellers are going to come in, buyers are going to come in. But over time, with anything, you begin to master it. And the key thing with time and sales is to understand that there's some things that are going to really stand out, okay? And sometimes you'll see some big size either hit the bid of support or lift the offers, okay? Sorry, lift the offers off support or hit the bids off resistance. Now, if you hitting the bids into support, you're not usually going to look for a short there because that's a breakout trade. You're going to usually look to manage your trade and maybe hold on to it. The sellers are hitting the bids aggressively into the lows. But if we're seeing sellers hitting the bids after a swing high on the time and sales, a good place to start looking for the short. One of the things I like to do is use the time and sales for the entry and then look at the market data footprints more so for managing the trade and staying with it. Okay? Hopefully that makes sense. Okay? So, the other thing to also watch for is not only the floods, okay, of buying and selling. So a selling flood will look something like this. A load of red prints coming in. Now, this is how my time and sales is color-coded. You can color-code it however you like. Okay, but generally in our trading room, red means more selling, green means more buying. It's just easier for your conscious and unconscious mind to pick this up. Generally my unconscious mind picks it up very quickly. I color code everything. If I see more red, it means sell. If I see more green, it means buy. Maybe if I get short and I see some more green coming in, it might be a combination of my charts, maybe a combination of time and sales, footprints. If I'm short and I see some more green coming in, I pretty much know I should be looking to either cover, get out, that sort of stuff. Right, so the other thing is, watch for the sizes. We see here in this example, 126 halves. Anytime we're seeing, you're always going to see the bid of the offer being traded. Okay, I mean, look at this example here. We have, 5 columns. We have the date or time for the trade. Okay, hence the reason it's called time. Okay, and then we have the sales. Okay, at each price where they're occurring. This is post-trade supply and demand. It's real trades coming into the market as they come in. Now, if you put in an order to sell 100 at 126 halves, it will show up if it gets filled as the next price. You can actually see your own trade. And not only can you see your own trade, you can see others' trades. And this is the beauty of this information. It's pure price transparency. And if you understand this and understand how to use it, it really is a beautiful thing. Okay? Where some traders think it's noise because they don't yet understand it or know how to use it. They think, oh, the seller's hitting the bid, so what? I'm long. I've got a green arrow here. There's no way that sellers are going to get through my entry and hit my stop because I've got a green arrow. You know, doesn't matter how many arrows you have, right? The fact of the matter is, if you have a green arrow and you're seeing more red here, you're in a bad position, right? Especially if there's some decent size coming against you. Now, I don't know how many of you guys don't yet follow the L2SD game plan and follow something else, and probably have experience at times where you see your trigger, you buy, and all of a sudden the market goes straight away against you and maybe whips you out and even hits your stop. Some of you may have even found you buy the market and all of a sudden, you know, it goes straight away against you. You sell the market, it goes straight away against you. The reason is because you're usually buying into selling or you're selling into buying. Okay? So, it's not the fact that your buy or sell trigger is wrong or the idea is wrong. It's purely because your timing is wrong. Okay, so that's what trade execution is all about. It's about timing. Because I might have an idea. Now, we open up each and every day in the trading room saying we're looking for sellers here, buyers here. Now, you know, just placing the order in doesn't make sense. But if I look for the evidence behind the selling where I'm expecting selling, look for the evidence behind the buying when I'm looking for the buying, it makes a hell of a lot of sense to get into the market. Now, if conditions change once I pull the trigger, then I will get out of the trade. Only then. So, good question there, Georgie. Okay. When you see selling, do you enter a market or wait for pullback and enter a limit order? Well, you can actually do both. Okay. So, if you see selling aggressively coming in, hitting the bid on the time of sales, okay, when you've seen a short setup and you're hitting your resistance, you can put the trigger straight away. However, if that selling is coming in a little bit too late, which I'll explain in a minute, okay, then you might wait for the pullback and put a limit order in because your trade location is poor. So basically, when it comes down to trade execution and timing, it's not only about when you're getting in, it's also about where you're getting in. Okay, if that makes sense. So I'll probably make a little bit more sense as I go on. I mean, hopefully you're happy with that answer for the moment. So it's not only about when you get in, it's also about where as well. So it all depends within the context of where your setup is occurring and what you see right now. There's no real right or wrong, if I could put it that way. Okay? So sometimes, you know, you'll just pull the bid if you're in a good place. Okay? You'll hit the bid. Sometimes you'll put a limit order in on the offer. But this is, you know, I use a combination of both. Sometimes I hit the bid, sometimes I put a limit order in on the offer. Sometimes I lift the offer, sometimes, you know, I put a limit order in on the bid. All depends what I think might get filled. Okay? Which you'll understand a little bit more so as time goes by. So, one of the other things you want to be aware of, is icebergs. Now, I'm aware of icebergs because I've had to use them. Okay, a lot of traders have never had to use them or had to come across them, so they don't know what iceberg trades are. Just out of interest, who doesn't know what an iceberg is? I know I've talked about it quite a lot in the trading room, so most of the trading room members should be aware of what it is. Yeah, exactly. Yeah, basically a lot of institutions will put in iceberg trades. Okay, so some of the traders, you know, always looking to fill the volume and look at, you know, certain size. Now, it's a good way to do it, but one of the reasons why I mean, the S&P, I might filter it, you know, for 10 lots or more, but, I mean, like the Dow, for example, you know, there's a lot of big traders trading the Dow, for example, but they're usually putting in ones and two lots. You know, you don't really see, you know, 1,000 lot coming in on the Dow. You know, you never see it because they never get filled. So, you know, the market's not liquid enough. But it doesn't mean someone's not trying to work in, you know, 1,000 contracts. It doesn't mean that. Okay, they might be trying to work it in as, you know, 4s and 5s or 1s and 2s all the way throughout the day. So what icebergs are is basically larger trades worked in smaller chunks. Now, I might want to sell 1,000 on the S&P, but I might work it in as 10s and 5s or 20s or whatever, so that I get filled. Because if I just chuck a 1,000 lot in, that order has to be worked. I'm more than likely going to get a partial fill. But there's some trading platforms such as Trading Technologies, Xtrader, what's it called? A Global Trader, Turbo Trader. Okay, there's some trading platforms allow for you to work in icebergs with bigger lots. Okay, and you can choose within what range you would accept getting filled your limits or whatever. Okay, so maybe you guys want to maybe try it out for yourself. But like on the Dow, you know, when I was trading 30, 40, 50 lots on the Dow, it's impossible to get that filled. Okay, I trade a lot smaller than that now. Okay, even on the Dow and the S&P. I have my reasons, and one of the reasons is basically you don't get filled. But and working the icebergs the way that I trade, you know, is not the best thing to do unless you're looking for a longer term position. But institutions usually looking to work in longer term positions will work in some trades as icebergs. So understand sometimes you might see a load of 1s and 2s coming in, you know, at one price or, you know, within a range of a couple of prices. And that's usually a sign of icebergs. Okay? So just be aware of them. Just be aware of what your competition might be doing. Okay? I know this not only because I've done it myself, but also because I've worked along traders that do this. Okay? That's why. Okay. Just give me a minute, guys. One of the things I was hoping to do was maybe show you some of the real time stuff in the on the actual charts. But to be honest, we do this each and every day in the trading room anyway, looking at the time of sales and also the market order footprints. So I'm going to continue with the presentation, and maybe we'll go back and have a look at some of the stuff that's happened. One of the things I do want to look at is time of sales before we move over to the market order footprints, as the market is still trading. So whilst we can still do that, let me just do that. Okay, so just flicking. Yep. The reason is you don't see Sean is because I was just switching to the market order footprints. So you should be able to hear me. If you can, just let me know. Okay, so basically, I mean, this is pretty short term. It's a 233 tick. Now, we usually use a combination of a 233 tick and a 1.25 range footprint. Okay, so one of the things I want you guys to look at is we're going to move at the footprints in a second, but what's the time and sales? Now, this is filtered, okay, but one of the things we look at is obviously you got the date and time every trade is coming in. Now, one of the things I look at is also the size in the bid and size in the offer. Now, I talked about pre-trade supply and demand. Now, actually, I'm going to show a few more columns. So what you can see is on the time of sales, this sort of thing you see. Okay. Now we've got the time and date for each trade as and when it's coming in. Not only can we see that, we can see the amount of size that is coming in. Now I've got this filter for showing trades with the volume of 10 or higher. Let me just put this on 0 so we don't have any filter. Okay. Now we can see obviously straight away a lot of green coming in. This is going to be flicking up and down, right? Okay, now we have the bid and ask price. Notice that we always have a bid and ask price. Okay, the market always has that 1 point spread between the bid and the offer. I mean, at the moment we're trading 91s on the S&P, 91 quarters, right? Every time we have the last trade on the bid, we see red prints. Every time we see the last trade on the offer, okay, we see green prints. See 91 quarter there, the offer is 91 quarter. Now 91s, okay, the bid is 91s, and we see more red, okay? So this is going to flick quite quickly if you have it unfiltered on the S&P. Now on the Dow, you don't really want it unfiltered. I mean, so on the Dow, you do want it unfiltered, okay? But you can see this is flicking up and down between buying and selling as we're coming into the first standard deviation high of today, okay? Now, one of the things you can do, as I said, is filter this out. So let's just look at 10 lots or higher, okay? Now, notice at 191s, we see 127 lift the offer. Now, one of the things we want to see is if we go 191 quarter afterwards, we do. We still see the buyers lift the offer, but then the sellers hit the bid at 191s with 100 lot. Okay, so this is a tick by tick basis. It's not for everyone. Okay, it's not for everyone. Okay, but and you don't want to watch this all the time. Okay, it's going to drive you crazy if you're watching the time and sales every tick of the day. You only want to move to this, very important, when you are about to look for an entry. I just talked about the buyers 100 lift the offer at 191s. Look how quickly we move to 192s. Are we not seeing a lot more green? Of course we are. Look at this, 500 lift the offer at 192 halves. Okay, so that's good for us to go 192.75s, and we do. Now this is tick by tick. Okay, now we see the sellers hit the bids. Okay, a lot more red coming in. Look what happens, we down tick, 3 ticks. This is tick by tick. Okay, but this is how the market trades. This is how the market facilitates trade. Okay, but within a few ticks, we can see the market is going to move up. Within a few ticks, we can see the market's going to move down. True or true? It is true. It's factual. It's real. It's true. You can't argue against it. Okay? If more buyers are lifting the offers and they continue to lift the offers into the next price, we're going to move higher until conditions change. Whether you believe it or not. Okay, this is always going to be true. So now we're lifting the offers at 1095, 1091.75s. We go 1092s, lift the offers. Now, if we still lift the offers at 1092 quarter, at the moment we cut off 1092. Okay, going offer, we go bid at 1091.75. Now there's resistance. Now we go back down. It is tick by tick, but it doesn't mean it's not true. Okay, but as I said, you're only going to look at this when you're looking to pull the trigger. Okay, now you can actually trade off time and sales alone. Okay, I've done it, but I would say it takes you time and practice. You might have to look at time and sales only, without no charts, no market profile, nothing else, just purely go on what's happening right now. Okay, but you can scalp off it perfectly. Okay, I could have taken a long there, taken my point and a half, could have gone short straight away, taken my point and a half very easily. Just within the second or few seconds that I brought this market up, we've seen evidence that this market should move higher, and it moved higher. We've seen evidence that it should get cut off towards the upside, and it moved lower. True or true? Okay, so all I talked about is looking at the size on the bid. If we're seeing more red, and we're seeing some decent size, 445 hit the bid, okay, we should go quarter. Okay, we do go quarter, 191 quarter. Does it mean we're going to go 191? No, but that sort of size coming in at 191 halves means there should at least be some follow through. You know, as I said, it doesn't mean we're going to get 100 points off it, 20 ticks or 50 ticks. It just means we're at least going to down tick. Okay, so using that information after you got a sell setup or a buy setup, you see some flood of selling with some decent size, see a flood of buying with some decent size, at least you know you've got a very good chance of at least going a tick or two in your favor as soon as you pull the trigger. Right? And if we're going to continue that trade, you're in a very good position to stay with it. But what happens if you go short with some evidence on the short side, or you go long with some evidence on the long side, and then all of a sudden the seller's coming against you or the buyer's coming against you? What does that tell you? It means straight away that even though you've executed the trade, it's time to rethink it, even though you've pulled the trigger. Straight away. If I get short and I can see the market go 2 or 3 ticks against me straight away, I know something's changed. Because the sort of setups that we're looking at and getting in with the sort of timing and execution we're talking about as day traders, that market should move in your direction pretty much straight away. And if it doesn't, you've got reasons to think about getting out of that trade. Okay, so we're short, for example, right now. There's a bit of buying coming in at 191 quarters. Doesn't mean we cut the trade completely. It at least means we cut some of the position and move our stop closer to break even. Okay, does that make sense? As I said, it's not the holy grail, nothing is, but if you can use this in line with your current trading plan, your current setups, even this alone will help you. Okay, more size hitting the bids, more green means pull the trigger. If you've got a long side trade, if you've got a buy trade, whether you're hitting support or what, you see some more green coming in. Look, 200 lift the offer, 100 lift the offer at 191 half. You lift the offer at 191 half, you pretty much guaranteed that market's going to go at least a couple of ticks in your favor. And look what happens. Goes 192. I see this happen each and every day. So that's why if I see this and I pull the trigger on it, I know the market moving in my direction soon as I pull the trigger. Okay, based upon just this evidence. I don't need to know whether this system is 80% right, 50% right. It doesn't matter. All of that is bullshit. Okay, the fact of the matter is you've got a long trigger, buyers are lifting the offer. Pull the trigger without hesitation. If conditions change as soon as you got into the trade, quite simply cut it. Okay, which I'm going to talk about. Does that make sense or what? Okay, as I said, if you don't quite get it straight away, we haven't got much time. I'm just simply covering some of the simple concepts that we look at for trade execution, trade management. This is time and sales. Very simple concept. Flood of buying, flood of selling. Once you've seen a long setup or a buy setup or a sell setup or a short setup, simply looking at some size, backing up your trade. Okay. Okay, so good question, Chris. Do you try to enter at the price of the sells, okay, or do you get below? So if you're looking at short, if you can see sellers hitting the bid, hit the bid with them. Okay, you might put a limit order in to offer to sell, but if you're going with the time of sales, go with the order flow. Hit the bid if the sellers are hitting the bid. Okay, because there's no guarantee you're going to go offer in order to fulfill your offer. Does that make sense? So go in at market or put in a source stop. Hit the bid, basically. Okay? Limit order at the bid. You'll get filled. Okay? Sellers are buyers lifting the offer. Some decent size coming in on the offer. Lift the offer. Join them. Okay? Sometimes, you might look to put in a limit order on the bid and put in a limit order on the offer. But as I said, you're not always going to get filled. So you might actually do that initially, but I mean, say for example, I want to get short 191s, 75s. I know we're trading the offer, so I know I can put a limit order in on the offer, but I'm going to have to sell into this buying. Okay. Most cases for newbies, you don't want to do that. You want to sell into the bids when the sellers are hitting the bid. So you're going with the order flow. The order flow is always with what's happening right now. The sellers are hitting the bid, that is the order flow. Okay, so you hit the bid. The buyers are lifting the offer, that is the order flow. You lift the offer. Okay? But in some cases, on more volatile markets like the Dow Jones, gold, oil, you can usually put in a limit order on the offer, even though the sellers are hitting the bid, and still get filled. And if you don't, and it looks like we go off a couple of ticks, and it looks like the sellers are hitting the bids aggressively, there's no chance you getting filled on the offer. You just move down your limit order, or pull it and hit the bid. That's what I do. It's a matter of doing that in a few milliseconds. Okay, so the real answer is it all depends on whether you look like you're going to get filled or not. Okay, it's always better to try and get a better price, put in a limit order on the bid or a limit order on the offer. But in most cases, when you're going with the momentum and and the market participants are reacting quite quickly, you have to do the same. So, in a nutshell, do what everybody else is doing, or do what the smart money is doing, or the most of the volume is doing. Okay. And if they're hitting the bids with some decent size, join them. If they're lifting the offers with some decent size, join them. Because the probability of you getting filled with a limit order on the bid, if the buyer's lifting the offers aggressively, is probably unlikely. You'll probably get left behind. Okay, so hopefully that answers your question. So, market delta footprints. For anybody that's new to this, I would recommend you go through Market Delta videos, marketdelta.com, and maybe review some of our videos on l2se.co.uk under the video tutorial section. Just go through the presentations I did, more so the second and third one for evidence and execution. But I would recommend each and every one of you review all 3 presentations we did with them, and also after today go over the Art of Adaptive Trading and the NLP for Traders event. If you purchased that or attended it in the past, you should have the recording. If you haven't, always a good time to get it now, so it makes more sense. Okay, you can see the sellers start hitting the bids at 191.95 91 halves. Okay, then we go 1 and 91 quarter. Then you just watch to see where we go 1 and 91s. If we don't, that means there's support. If we do, you pretty much good to hold the short. Okay, so we're going 1 and 91 quarter. There we go 1 and 91. Hold the short. Very simple concept. All you got to do is understand it and trade it. Does that make sense to everyone? Hopefully. Okay, now I'm going to move back to the presentation. To see the presentation again. Just a quick bit of feedback. Just make sure you guys, as I said, it's a very simple concept. Don't need to complicate it any more than that. Flutter buying, flutter selling. Look at the size and the bid. Okay, look at the size that's lifting the offers. That's it. You don't need to know any more than that. Okay. Some of you guys, if you're confused in any way, just let go of that blockage. Just that is what it is. I'm telling you right now, if you can just understand that concept, just take that away and work with it. Okay? I don't need to complicate it for you. Okay? There's no reason, because all it is watching what's hitting the bid and what's lifting the offer in terms of size. Okay? That's all. I could try and complicate it for you, but there's no point. Okay? That's all you need to understand. Watch it, read it, trade off it, and you'll learn. You'll understand. You'll master it. Okay? Over time. Okay? Anyway, let's move on to the footprints now. This is basically taking the time of sales onto a different level. Thanks, Philip. Thanks, Maddie. Glad you guys understand it. I'm hoping that the rest of you guys do as well. Okay? If not, just review. As I said, there's not much else to get from it. Just quite simply, just go through it again. You don't really need to know any more than that. There's certain size that will move a particular market. Okay. Now, for the S&P, for example, 100 lots, 200 lots coming into the market is pretty good. Okay. Now on the Dow, you're never going to see 100 lots, 200 lots hitting the bid or lifting the offer, because they're not going to get filled. Okay. So it all depends on what kind of market you're trading. Okay. So think about it in terms of volatility and liquidity. Think about your market and what you're trading. Now, if your market usually trades, 20, 30 at a particular price, the chance of you, getting a 100 print or a 200 print hitting the bid or lifting the offer is probably not going to happen, right? So understand the market. That you just think about it logically. It's not rocket science, just think about it. Look, this market trades, 100,000 contracts a day. I'm looking at market data footprints. It's usually giving me sort of, 100 lots, 50 lots trading at each price. So what's the expectancy of me seeing maybe 1,000 lot trading in one go? Very unlikely. Probably won't never happen. Okay. But the S&P, you see usually, thousands, 2,000, 300s hitting the bid, lifting the offer. So, seeing some size 200, 300 lots hitting the bid, lifting the offer, it's quite likely, right? But you never see that on the Dow. So it's all relevant to the market you're trading. So understand that. And the thing is, just watch the market you trade. Doesn't matter whether you're trading the FTSE, the Euro stocks, the DAX, the Dow, the S&P, gold, silver, doesn't matter. You name it. Doesn't matter if you're trading apples, right? All you got to do is watch time sales. You'll quickly learn from watching it over a few days how many people want to buy, okay, or sell that market. What kind of size usually turns around that market. You don't even have to, nobody has to tell you, nobody has to teach you, I don't even have to teach you. All you got to do is watch and observe. Okay, that's exactly what me and Brian done. Okay, all we do is watch and observe. We watch a market. Okay, I want to trade this market. What kind of size turns around this market? what kind of sellers, what kind of size comes in on the sell side before this market turns around and goes downside. What kind of size usually comes in when I'm watching this market off support and I see it go upside? It's quite simply a matter of asking those questions, self-inquiry. Don't complicate it. It's quite simple. The markets actually give you the answer. Okay, I don't even need to give you it. Okay, now I can give you some ideas, sort of things that I've learned over time. But as I said, make it your own. Become your own coach, become your own master. Okay, take some of the things me and Brian share you, make it your own. Okay, so that's the thing you got to do in this business. Me and Brian do that. We learn a few things here and there from others, but most of the stuff we actually learn through experience from picking it up ourselves. So you have to do exactly the same thing. Learn the concept, learn the idea, understand it, and then apply it. That's it. Understand that the more sellers are hitting the bid with more volume, the market's going to move down. The more buyers are lifting the offer with more volume, the more the chance the market's going to move up. So if you understand that simple concept, and it is very simple, and you just understand it, master it, and trade with it, you're in a very good position. Probably in a better position than most traders are. Okay, and that's a very good position to be. So just do that. Okay, if not for yourself, do it for me. But I don't need you to do it for me. But please, just try it out for yourself. Okay, that's what I say. So anyway, let's look at the market data footprints. Everyone's probably a little bit aware of what the footprints are and what they show us. Now, one of the simplest ways to show this is looking at the bid and the offer. Okay, but an even more simpler way to look at it is by looking at the delta, which is the difference between the bid and the offer, which I'm going to show you. Which is probably pretty much what we look at in the trading room most of the time. Okay, so let's look at reading the bid-ask information. So this is an example, sort of thing you might see from a bar-to-bar basis. Now, this bar might form every minute. Good stuff, Betty. Sorry, Anthony. You do it for Betty. That's lovely. That sort of thing. For that's I do it for my family. That's who I am. I do it for people I love, and if that can be your reason for doing things, you're in a good position. Okay, if that's why you do it, the universe will serve you. I'm a big believer in doing everything out of love, and if you do it from that perspective, you do very well. So let's move on. Okay, so the example of a demand exceeding supply, okay, equals basically buyers aggressively lifting the offers. That is the real evidence, okay, of buyers lifting the offers. Okay, the real evidence of demand is when you see more volume coming in on the offer and lifting the offers at sequentially higher prices. Keyword, sequentially. If we lift the offers at 998 and we couldn't go offer at 999, okay, and lift the offers there, and then we couldn't go offer at 1,000, it's always in a sequence. You want to see this happen in a sequence. So if we go offer at 998, it's probably, not much to go on. But if we go 998, 999 with some decent volume, definitely some follow through, use that information. Okay, so understand the importance of follow through. Now, let's talk about the example of supply exceeding demand, okay, which is sellers aggressively hitting the bids. So this is what it will look like, okay. Usually you have the price, okay, might be on the right hand side of your chart, okay, might be on the left hand side. Now this is an example. I'll show you an example in a second anyway when we move to the chart. But basically we see the price usually on the side of the chart, right hand side, okay, usually the common practice, okay, and then we see the bid on the footprints. If you have the bid-ask view, that is, you'll usually see the volume hitting the bid or actually trading at the bid accumulated here. So, on the time and sales, you usually see each trade coming in one by one at each price. But what the market data footprints does, it actually accumulates as each price trades. It accumulates the amount of volume traded on the bid and the amount of volume traded on the offer, which is excellent, okay? Because with time and sales, as you can see, it moves quite quickly, okay? Which you can still trade off, but seeing the accumulation of this information, okay, at each price gives you a massive edge over somebody that's not using this. Yeah? So in this case, 1002, you can see 1100 hit the bid, and only 140 lift the offer. Okay, so this is post-trade supply and demand, not resting orders on the bid in the offer. Post-trade supply and demand. If you didn't quite understand that concept, you might have to go over this presentation before, again. But understand that we're looking at post-trade supply and demand when we're looking at time of sales and market order footprints. So 1002, 1100 hit the bid, 140 lift the offer, a lot more on the bid. So, we move down, okay, to 1001, 2500 hit the bid, still some decent volume. Outweighing the resting orders in the bid, not many aggressive traders willing to lift the offer, only 60. We move down to 1000. When you see something like this kind of volume coming in on the bid and small volume coming in on the offer, the likelihood of you moving down is very good. Okay, so the better you understand this information, this is pure price transparency. This is what moves the markets. If you understand it and learn how to read it well, there's no way you can fail in this business. Okay, no way. And I say that very confidently because I do it on a daily basis. Brian does it on a daily basis, and anybody that we've ever coached or taught that learns to understand it and master it and does it on a daily basis always succeeds. So if you have any limiting beliefs, let go of them right now and just do what you need to do and understand it until you get it. And if you don't quite understand it yet, that's fine. Just step back and learn it very well until you do. Because when you will get it and you will understand it, and when you master it, as I said, because you're using the information that actually moves the market and you use it well, there's no way you can fail with it. Okay? It's a bold statement, but it's true. Okay? Anyway, let's move on. So now, what's the delta? What is the delta? The delta is the net difference between the bid-ask volume. Okay? So we've got the volume on the bid, we've got the volume on the offer. Now, we can display this, okay, from a perspective on each price, or we can show it from a bar-to-bar basis, which I'm going to show you. Okay? So let's have a look at positive delta will look something like this. Okay? So it's a net difference between the buying and selling volume. Okay? So obviously, if we have more volume on the bid, it's going to be negative. If we have more volume on the offer, it's going to be positive. Okay? So, we might have 1,000 hit the bid, okay, and only 700 lift the offer. And then we get a positive delta of 300. So that's the way you've got to look at it. So it's going to be the difference between the bid and the offer. Okay? So it's usually the bid take away the offer. Okay? So if we have a more positive delta, building consistently at higher, sequentially higher prices, that means the market is going to move higher until we are unable to build a higher positive delta or find more volume on the offer. Okay? Until we are able to do that. So, we will always have a negative delta at a low because the market will only go bid on a low and we will only go offer on a high. In some cases, you might go bid and offer on a high, but most cases you don't. And negative price delta will look something like this. You'll see a negative number, usually in red in my case, okay, with my color coding. So 1002s, 1001s, 1002, 99 sevens. We can see 11,000, 2,500, good negative delta all the way down. So this is obviously a hypothetical example, but this is, what the footprints look like. Okay? So, we're hitting 9 o'clock now, so have a quick 5-minute break and we'll continue. If that's okay with everyone. If you've got any questions so far, please feel free to fire away. Well, the thing is, if you have a good understanding of structure, you have an idea of where most guys that are really sort of understanding what they should be doing are looking to respond. So if we're coming into a particular area of resistance, most good traders will be looking to execute trades there. Okay, and if we're coming into an area of support in terms of how we understand structure, we're generally looking for buyers to respond there. So the short covering or long liquidation, can be occurring, but most cases it won't be followed through. So in most cases, in terms of, you'll be able to read it more so as well as off the footprint, you'll also be able to read it off the price charts more so. I would say you probably don't need to be so concerned about covering rather than execution, because what you're looking for off the time and sales more than anything, and the footprint is more so for entry. And although you will cover some profits when you see some evidence of the footprints and maybe even get out of trades, when you see the evidence, you do get out. Okay, that's the main thing. It doesn't matter whether they're executing trades. A trade is a trade. Whether a buyer or seller is entering a trade or executing a trade, if there's enough size, there may possibly be some follow through. Okay, so whether it's an entry or an exit for a trader, it would generally give you some movement in order to at least profit from. Whether it's the first, second profit target remains to be seen. But whenever we first see some evidence of order flow, it's always just that that the market may potentially find support or resistance and reverse. It doesn't tell you how far the market's going to go. So whether it's entries or whether it's long or short covering, it doesn't matter. One of the things you can understand more so, I think you've got to be more concerned about short covering, long liquidation from a longer time frame perspective. So those traders, the institutions that are trading more from day time frame, weekly time frames, which you get more of a feel from market profile than time of sales and market order footprints. The scalpers will be in and out all day long. So I wouldn't be too concerned about when they're entering and exiting out of the markets. Entering, yes, maybe, but not exiting. So I wouldn't be, I would say, you say in the next comment, maybe you're thinking too much about this. So I wouldn't think about it too much. Basically, once you see the evidence, whether sellers are hitting the bids or buyers lifting the offers, that's good enough for you to take your entry. So you're going based upon your perception of value, your perception of this trade. You don't need to figure out whether they're going to be short covering or long liquidating their longs. All you need to be looking for is some evidence for some longs coming into the market or shorts coming into the market before you take your trade, whether they're covering or whether they're entering new shorts. Really and truly, you don't need to concern yourself with too much, if that makes sense. Okay, at the end of the day, trade is trade, and it's more the follow through. What happens after that, it's more of a concern. That's why what I'm going to talk about next, when you enter the trade, it's more about trade management more than anything else. We're talking about entry here and execution, but the most important thing is going to be how you manage a trade once you're in. Most traders think about, thinking so much about getting into the trade, whether they're going to be right or wrong, which I'm going to talk about next is, just get in. If you're wrong, you get out. Simple as that. What would you like to see on the footprint before you look to the time and sales window for final execution? Well, one of the things that I would generally look at is the footprint, the time and sales probably before I look at the footprint. So maybe buying is coming into a potential resistance area, for example, the first standard deviation high where we're expecting sellers, and I might actually see the selling coming in firstly on the time and sales before I do see the evidence behind that on the footprint. So I might actually enter off the time and sales and manage the trade or look at reasons to stay with the trade more so by looking at the footprint. But otherwise, I think for new traders, they're probably going to use more of a combination of the footprint and the time and sales together. Okay, and usually it's you look at the market delta footprints, for example, a particular delta reading, negative or positive, okay, to be a certain level. So, for example, on the S&P, we talk about 500 negative or 500 positive delta. So that's the net difference between the buying and selling. For those that are not too familiar with delta, so I just talked about. And then once you're about to pull the trigger, soon as you're about to pull the trigger, all you're doing is watching for the time and sales. Okay, are the sellers continue to hit the bid after you've seen that evidence on the footprint? If that makes sense. Well, I'll show you some examples anyway. Yep, good. Okay, so let's move on. These are the oh, time is going by so quickly, but we still got quite a bit to get through. Let's get going. Right, so why do we use the footprints? Okay, basically for better execution. Okay, So understand what the market data footprints are showing you, and understand it's key as a tool for applying for execution. Understand and learn that the patterns that are to be shown by repetition of recognition, okay, understand that the patterns that we are about to show you, basically you'll be able to see them more easily through the repetition of recognition, meaning more screen time. Seeing things again and again and again always helps you, not only on the conscious level, but the unconscious level will usually learn more quickly if you see things happen rapidly. One of the things I recommend is the market delta playback method, where you watch the timer sales and the footprints back after they're finished and look to actually execute some simulated trades using the market delta simulator platform based upon your playback, which you can do, okay, in the new version. So if you haven't understood that, that's one of the best things. I always recommend you maybe go back a few days, so you don't really remember what happened, and then look to trade it based upon the evidence you see, just to practice your skills. And the great thing is you can play it back at a much faster speed, and your unconscious mind always learns more quickly the more quicker something is played back. So some of you might actually have this belief where you actually learn. I mean, even right now in this presentation, sometimes I talk quickly. Some of you may actually feel that you're not learning because you're not actually taking it in so much consciously. But let me tell you one thing. I've been doing this a long time, and one thing that you'll learn is your unconscious mind learns more quickly. So sometimes the quicker I go through things, okay, you'll actually learn it better, but you might not actually understand you've learned it better until you put it into practice. Okay, so that's why, sometimes if you want to learn this more consciously, go back and, review it. That's why we always record our events. You have to listen to it and go back and do it again and do it again. Okay, if you learn through more conscious effort. But as I said, your unconscious mind is, your conscious mind works, like, from a picture or frame by frame basis. Your unconscious mind is like, it takes in the whole movie, in one go. It understands the whole story in one go. Your conscious mind, maybe right now through this presentation, taking a snapshot, because it's trying to remember everything and try to comprehend everything. Whereas your unconscious mind is just seeing the movie, it's taking it all in straight away. If you learn how to use the power of the unconscious mind, it will work for you rather than against you. Okay? Way beyond the scope of this presentation, but I'm going to talk about that a little bit in a little while. Okay, so hopefully I'm not losing anyone here, and if I am, I'm probably only losing you on a conscious level, not on an unconscious level. Okay, so just understand that. I understand it, so yeah, just understand it. Just trust me. Okay, just trust your unconscious mind. They're taking the information you're learning. Okay, so the other thing is, that's why I say, you've got to play this stuff back and watch it again and again and again. Watch it each and every day. More screen time means more experience, more practice, and closer towards mastery. Simple as that. So understand that execution is all about timing, okay, based upon evidence of order flow. Learn to recognize what patterns of volume or delta are significant for the market that you will trade. So that's what I talked about earlier. The S&P moves on a different volume compared to the Dow. We talk about this in the trading room, so if you're not yet joined the trading room and seen this, you begin to see it. So, market delta footprints, execution setup. Firstly, it's good to keep things simple, okay, to get started, as you'll gain more experience with reading and trading with the footprints. Okay, you will consciously and more unconsciously begin to recognize more and more patterns for execution as you trade. It's basically what I do. I just tap into the unconscious level and I trade pretty much automatically, just trusting my unconscious to recognize these patterns and trading off them. Quite simple. Okay, but you've got to learn how to do it. Tap into that power and use it. There's massive potential there. Okay, most traders don't know how to work from that higher level of consciousness. That's why they struggle. So one of the things that we often talk about, with what we do in the trading room and the events we do is always a lot about the mindset. I find it quite interesting. Most traders do pay more attention to the technical aspects rather than the mindset aspects. And, it's, we do like to push the mindset aspects, and because it's very important. But you know, what can we do? You know, we explained the importance of it. You know, we can't force you to do anything, but you know, the sooner you realize that the mindset is very important, the better. Okay. Um, all we can continue to do is just do the best we can in terms of coaching people, and you know, hopefully share the truth, and you know, you guys actually understand what we're sharing is the truth. That's all we can do. Do the best we do. Okay, so what you got to do, I always talk about unconscious competence and moving from more conscious competence, knowing what you got to do and thinking about what you got to do, to more of an automatic response and just doing what you got to do from a very high level of understanding. And this is what most of you guys want to sort of be, you know, start to work towards, especially in terms of execution. Okay, so let's just look at some of the simple patterns and examples that we look at. And so you don't even need to look at any more than this. Only really take a trade when you see these patterns on your footprints. Otherwise, leave the trade alone. Now, there's over time you'll see other trades and setups that you can take, okay, from reading the order flow and footprints. But for now, this is all you need to get yourself going. Okay. As I said, we've done as much hard work as we possibly can for you. Okay, so you can just sort of work with this. Okay, so let me give you an execution setup for a buy setup and a sell setup. Some of you may have gone through this on the 3-day event or the one-on-one coaching. For you guys that haven't, you know, just take this in. Okay, so you got to remember this is all fitting into the L2ST game plan, which is steps 1 to 5. This is only step 4 when we're looking at evidence and execution behind a setup. So you have to have actually understood where you are in the marketplace, where you are expecting sellers and buyers to respond. Once you know where you're expecting them to respond, you then look for something that identifies the opportunity, such as a divergence. Okay. And then you need to just look at your potential risk reward in the trade, which is step 3. Okay. And then you look at step 4, which is this. Okay. Where you're looking to just pull the trigger. Everything else is in place. You've understood where you are. You know you want to be a buyer. You know you want to be a seller. You've seen the opportunity, high probability setup. You've worked out your risk to reward. You just want to pull the trigger now. Okay? So this is just really purely about timing. Okay? So one of the things you can do, okay? These are the simple setups you want to stick with, okay, and I use on a day-to-day basis. To buy, firstly, you want to find that selling has been cut off and that we are stalling a down move. Okay? You can then check for the order book for resting support to lean on. For example, more resting orders on the current bid or below the current bid as support. Okay? You don't have to necessarily do that to start with. Okay? Then the setup for actual entry for you to pull the trigger will be looking for a new low bar which is showing a positive dollar at a price within 2 to 3 ticks of the last low. So the market's made a low. It's proved that the selling has been cut off. Now, within 2 to 3 ticks of that low being made, the higher delta readings or volume on the offer is going to give you a good signal to buy. Okay, so the higher the delta reading or the volume towards the low end of the bar, the higher the probability the trade will play off. This can be further confirmed with a smaller tick chart. Okay, so the sort of thing you look at is this. This is an example of a buy setup. Actually, just give you 30 seconds or so. Just take that in. And just quickly look at this. You can see is, you know, this is a bid and offer view for any of you that haven't seen it before. And the volume on the left-hand side is the volume filled on the bid. So remember, if we have more volume on the bid side, that means more sellers are hitting the bid. We have more volume on the offer, that means more buyers lifting the offer. Okay, usually when the market's going to top out, we're going to see sellers start hitting the bid at a higher price. Okay, so you can see 403 hit the bid, only 43 lift the offer, then 433 hit the bid, only 0 lift the offer, more volume on the bid, okay, and then we see follow through all the way down. When is the selling cutoff? Okay, firstly, when only 174 hit the bid and only 0 on the offer. You can probably just about see that. The other thing I look at is delta divergence. Okay, the market has made a lower low, okay, and I use a volume breakdown indicator. Okay, for you guys that haven't seen this yet, join the trading room. You have to get in there to see this more clearly. Okay, the volume breakdown is showing us basically from a bar to bar basis. We can see from a price to price basis where the most selling is, where the most buying is. Okay, but as I said, the delta is not only from a price to price basis, it's also from a bar to bar basis. So one of the things we can see, the delta changes turn more positive. What is the delta change? The delta change is basically showing us that if you look at the delta, it was minus 3322, and then it went minus 22 something, okay? Whatever it is, I can't see that because the arrow's in the way. But we had a delta change, which is more positive. So there's less selling in this footprint, although there was selling in this footprint. Okay, overall there was less selling than there was in the bar before. Okay, so what that means is a heads up that selling is filtering out and buying is coming in. So that's why we see the delta change of a positive 1098. So that's always a heads up. So it's always good to see a delta change before you look to get long. And that's a heads up before you even get to your support ready to buy. And then all you got to do is watch the time and sales, see whether the buyers start to come in, or look at your footprint. I mean, in this case, 1018s on the S&P, only 593 hit the bid, 1977 lift the offer. That's the volume and size of contracts lifting the offers, okay, compared to the volume of hitting the bids. You can see this price is green because that means there's more buying. If it's red, the price, it means there's more selling on the bid. If the price is green, that means there's more buying on the offer, right? Now, you can either get in off this footprint, which is a 1.25 range footprint for the S&P, or use a smaller time frame, which you guys see me doing in the trading room, okay, to confirm that and get an even better entry. So you see this is now just in a delta view. So we're not looking at the net difference between buying and selling volume. So we're not looking at just the bid and the offer. We're looking at the overall delta, which is the net difference between the buying and selling volume at each price. So if there's more buying on the offer, it's going to be green and it's going to be a positive number. If there's more selling at the bid, it's going to be a negative number and it's going to be red. Does that make sense? Okay, so the question here from Brian Johnson is, would you wait for that bar to complete before entry, or so what would your entry be? No, you would not wait for this bar to complete. You have to anticipate that the buyers are lifting the offers at a new potential low. Now, for some guys that are new to this, it might be easier for this bar to close with a positive delta and then buy it in the next bar, which is actually how I started trading the footprints. But if you really want to get an edge, learn to identify the buying as it's building, or identify the selling as it's building. Now, we might see more buying at 1018s, and we might come back and fill in some more selling at the bid after you get in. And if that happens, then you've got to be prepared to exit the trade. Okay, that's all I can say. It's all about trade management. But if you want to be a little bit more conservative, wait for this footprint to close and wait for the next footprint to open with a positive delta, and then look for the buy to come in. That'd be more of a conservative entry. There's nothing wrong with doing that. It's just that I personally found I got used to getting in intra-bar at a particular price as it's building. Hopefully that makes sense. So with the 144 tick, for example, 1018 is where we see the buying, but you might not actually, you might put a limit order in there to buy, but you probably will lean on that. Okay, so high positive delta there. What you do is lean on that and buy on the follow through at 18 quarters. So you lift the offer with those buyers that are lifting the offer here. Okay. So, we might go bid here 1018, but rather than put a limit, you probably lift the offer here with the delta here. Okay, so that makes sense. Pretty simple concept. So on the sell side, what do we look for? Okay. On the sell side, it's obviously the opposite. Okay, we find that buying has been cut off and we are stalling an up move, so we're coming into resistance and we're looking for potential sellers. Okay, we basically check the order book if we want to. We don't have to. Okay, for resting resistance to lean on. Okay, and possibly less bids on the resting side on the order book as support. Okay, the setup for actual entry can be confirmed by looking for a new high bar, which is showing a negative delta at a price or prices within 2 to 3 ticks of the last high. The higher the delta reading and the volume towards the high end of the bar, the higher the probability that the trade will play off. So the example here is this. Okay, so we can see there's buying coming into 191.5, so we don't want to sell there. 106, okay, buying coming in there. So as soon as we see negative delta 2017, so that means that in terms of volume, there's this many sellers, okay, 2017 more sellers than buyers, okay, at this price, which means that's a good heads up to get short. You might not actually pull the trigger there, okay, just in case more buying comes in, but what you might do is move down to a smaller footprint. You can use this footprint and pull, you know, minus 378 negative delta as it's building, so you got follow through, or use the 233 tick in this case, okay, or whatever time frame you like, something that's smaller. You see minus 809, 159, minus 458 negative delta. So confirm negative delta, offer to sell, but then we actually hit the bid here at 191 because we've downticked and proved that this selling has actually caused at least a downtick. That's all it calls. That's all it takes is a downtick or an uptick, okay, in order for you to pull the trigger. Now, some of you with over time, like I have, okay, you will actually be able to pull the trigger, okay, even before you get this downtick or the uptick. But as I would say, for most of you, you know, stick with this. Watch for at least a follow through, at least a tick, okay, or two. Now on the Dow, it might be a tick or two because it's a little bit more volatile than other markets. But the S&P is less volatile, more liquid. You know, all you need is really a tick follow through. Okay, hopefully that makes sense, guys. Just give you a few seconds to take that in. For 1 minute, and I'll be back shortly. The amount of volume on the offer and the bid, okay, and just understand pre-trade and post-trade supply and demand. Just understand the concept and the theory, okay, and then you'll understand the application of the tools, rather than focus so much on the actual tools and the setups themselves. Okay, so it's just an idea of what you might want to do. But that's basically what I had to do myself. That's why I sort of share that idea, because a lot of what I sort of picked up when I was learning this didn't really sort of make sense until I actually applied it and applied the theory itself. Okay, so yeah, and to be honest, nobody really sort of told you the setups anyway. Okay, in terms of order flow. But you know, this simple sort of concept. You know, if the buyers are sort of lifting the offers, you see this sort of example here. Notice when the buyers lifting the offers, usually the buying is usually within sort of 3 to 4 ticks of the highs. That's why I say if you see selling within 2 to 3 ticks of the high, that usually means the market's going to turn around, because it usually continues if you're still seeing buying, okay, in sort of 3 to 4 ticks of the high. So it's a key thing to sort of watch for, okay. And I mean, as soon as I see that, as soon as I see sellers are hitting the bids at higher prices within a few prices of the high being made or the new low being made, I pretty much just pull the trigger straight away, because it's something which you see all the time, and it's what most of the guys that are really sort of making money in this business are doing. Okay, they're getting in close to highs and close to lows. Okay, close to lows when they want to buy, close to the highs when they want to sell. So if you're seeing the evidence behind that, join them. You know, do the same. I see it all the time. Any sort of market, every single market you pretty much put up, you see these patterns. Okay. Believe me or not, okay, it's true. And so sometimes, you know, what I share with you may not actually be your belief as yet, okay, and it may not be your truth. So I will always express, you know, from my understanding, from my experience, my own experience, and from my own belief system. That's the best I can do. So, you know, sometimes I say to the guys that I coach and train, I say, look, I'm going to tell you a bunch of lies, okay, until they become your truths. right? So that's the way you got to look at it. Okay, so you got to prove yourself. You got to prove that this is right to yourself. You got to prove it's true to you. Okay, that's what you got to do. So don't take it at face value. Try it on for yourself and test it. That's what you got to do. Okay, and then you will build confidence. You will build belief. If you come from that level of being where you have belief and confidence in yourself, okay, you're in a much better position to perform. But if you're just going back on the back of what I'm sharing with you or somebody else has shared with you, okay, you're always going to have that level of doubt. Okay, so to eliminate that level of doubt, what you got to do is actually experience this for yourself. Okay, make it your truth. Okay, so that's what you got to do. No, it's not basically a counter trend approach. Well, it depends basically in which context you're looking at. So we're always trading it in the context. So this might be, say for example, this is a pullback. Okay, so this might be a pullback in the direction of a downtrend, and then we're looking to get short in the continuation for the continuation move. Okay, or if in a sideways market, this might be sellers coming in near the resistance of the range. So it depends on which context you're trading. So you have to understand structure and where you're taking these trades. Obviously, first of all. So, this you would apply this concept whether you're going with the trend on a bounce or a pullback, as well as if you're selling a high, picking a top or bottom above or below value in a sideways market. So what you've got to understand is that's why we say structure is so important, and understanding value and market. The understanding the behavior of market participants is so important. You can't just trade off order flow alone. You can't just take what I'm teaching you right now and execution and trade management and just expect to succeed, because it has to be taken into context with the rest of the game plan. Remember, this is step 4 to 5 we were discussing of the game plan. You have to follow step 1 through to 5. So if you haven't yet understood step 1 to 3, you can't even yet move to order flow and execution and trade management, because you haven't yet understood whether you should actually be getting into a trade, or what the risk to reward is, or whether there's actually you should be a buyer or a seller or what. So, this is all about when you've actually seen the opportunity, you know what you want to do, and you just want to get into the trade. It's all about timing, okay, and evidence behind your trade setup. Because sometimes you'll get trade setups, okay, it doesn't matter if your trading system is 30% profitable or 99.9% profitable, okay, doesn't matter, okay. If you follow evidence with order flow behind that trade setup, you will make it more profitable, okay. You can get a trading system or methodology which is only right 30% of the time, okay, and make it right 90% of the time purely by disqualifying and qualifying certain trades, okay. So one of the things that I do, through trade execution, trade management, okay. So you've got to understand that. Okay, let's continue. So that is quite simply the sort of things you've got to be looking at on the market data footprints, okay. There's not a lot more to it, okay. Now, one of the things I want to I'm going to focus on the charts in a little while, okay, if we get much time, but I do want to touch a little bit on the mindset. I know a lot of traders don't really like to delve into this until they've really had to, okay. So anybody that's new to trading here or yet hasn't had to conquer themselves, okay, and their mindset and the way of thinking, I always like to give you an idea of the sort of things you might expect, okay, in times to come. Okay, sometimes you have to experience it for yourself before you actually understand what I'm talking about. Usually with newbie traders, sort of, new traders that have only been in this maybe a few months, they sort of don't really understand why I would want to discuss the mindset and why I focus a lot on coaching traders on the psychology of risk and handling fear and limiting beliefs. It's probably where I spend most of my time coaching traders one-on-one, especially professional traders, because that's usually where they need to continuously work on rather than their strategy or methodology. Okay, so although we have a methodology and a way to trade here, okay, which is profitable, you obviously got to make it work for yourself, and usually the reason that comes in the way is quite simply yourself, okay, the way of thinking and who you are. Some people don't like to hear it, but the way we work, you either get the truth or you don't, and we will always share the truth. So one of the things you have to understand, I get emails all the time, okay, they see everything, you understand everything, you know exactly what you got to do, okay, you just can't pull the trigger. You come into the market each and every day, okay, you understand exactly what you got to look for, you know exactly where you're going to buy and sell. As soon as the market gets there, you see the evidence on the market delta, footprint, time of sales, and you yet still don't pull the trigger. Okay, so what do you do about this? What do you do? I don't know if anybody's ever experienced this. Most traders have. Most traders and some traders just won't open up to it. Okay, and basically I've just got some very simple things. You know, it doesn't. You don't. As I said, you don't have to complicate it. You know, we keep it simple, right? As I said, you know, each and every day in the trading when we show you the trades, where to buy, where to sell. I mean, this week, for example, we had the game plan in mind, where we're looking for buyers and sellers. All you had to pretty much do was move to the order flow and pull the trigger, okay? And you would have had an excellent week, okay? But yet, some traders will still fail to do it. Why? Okay? A lot of the time, it comes down to the fear of pulling the trigger. Just don't pull the trigger. Just don't get into the trade, okay? So one of the things I want to talk about, okay, very important, we're talking about execution now, is how to overcome this, okay? Very simple concept, okay, that I'm going to share with you. There's many different ways, but just to give you an idea, you know, I'm teaching you guys what to look for in terms of evidence and order flow. Now, obviously, you got to make sure you trade off it, right? So if you're not sure if you should execute the trade, okay, which some traders are, and usually they are in the trading business because we're in a business here where it's not a game of certainty. Okay, there's no way you can get certainty behind the market. You can get confidence, yes, but there's no way you can be 100% certain that your trade is going to play off. Okay, I've been in this business for a while now, and I'm consistently profitable, I'm happy to say, but I still don't trade with certainty. I have very high confidence in my ability to make money in the business on a daily basis, but I still have uncertainty. Okay, but for me, that's what makes it fun. Okay, so if you're not sure if you should execute a trade after you've understood the market structure, okay, a lot of traders ask me this, okay, they've seen it all, they know exactly what they've got to do, okay, but they fail to pull the trigger, okay, they ask me, what should I do? I say take the trade anyway, okay, simple, right? If you're not sure and you've seen all the evidence, steps 1 to 3, okay, and even 4, you've got the evidence behind the trade, there's no reason why you shouldn't take the trade. Now think about it logically. You've got a high probability structure that you're sticking to. You know where the buy and sellers are going to be. You're at that price or at that level, okay, or in that area to buy or sell. You've worked out that you've got a high probability set up there. You've worked out your risk to reward. You're going to risk maybe 1% to make 5% in this trade, for example, and you've seen the evidence behind the trade. Why on earth would you not pull the trigger? The only reason you might not is because you either have fear, or let's put it in better words, you're shitting yourself, right? So what you got to do is basically take the trade anyway, right? Just take it. That's what I say. Even if it's in sim mode initially to get used to it, you'll realize the ability, okay, to pull the trigger once you have steps 1 to 4 in place is basically the way into success in this game. Because if you're failing at step 4 when everything is in place, the only thing that's in the way is you, unfortunately, whether you like it or not. Okay? So, as I said, simple thing, take the trade anyway. If you're not sure, take it. Anything comes in, your monkey mind starts chatting away, saying, oh, last time I took this trade, I lost this much money, I lost $200, maybe I lost $20,000, doesn't matter. Take the trade anyway. Okay, the fact of the matter is you've got steps 1 to 4, doesn't matter what your mind is saying. If your monkey mind is chatting, shut it up and take the trade. Okay, simple. Right? So some of the best you will ever trade, some of the best trades you will actually take will actually come out of fear. Believe it or not. Okay? One of the things that holds most people back in trading is fear. Okay? Everyone experiences it. Okay? So use it. That's what I say. You don't fight it. Don't try to eliminate fear, which some psychology coaches try to teach you. Don't eliminate it. Use it. Okay? One thing that's great that comes with fear is adrenaline. Okay? You make the adrenaline work for you, it serves you. Okay? So use the fear as a trigger. Embrace it. Do this and fear will become your friend. Okay? And then over time, the fear disappears because the fear is no longer fear. It becomes confidence. Because every time you use it, it serves you rather than works against you. Does that make sense? So as I said, one of the things I would like each and every one of you to do, every time you experience fear about a particular trade and you're not sure or you develop doubt, pull the trigger. Okay? I can guarantee you most of the time it will work in your favor. Why? Because you've already followed step 1 to 4. So if you're failing at step 4 purely because of your mindset and your way of thinking, only you are in the way, believe it or not. Only you are in the way. Maybe not you as a person, but your mind, the way you're thinking, okay, what your thoughts are, okay, they're blocking you. And in trading, in day trading especially, you haven't got time to think. You haven't got time, especially negative thinking. Okay? Good. We got 3 people that understand. Okay? 1%. Actually, it's about 5%. Sort of makes sense. Okay? 5% of traders usually succeed. Right, okay. So, usually fear is not there because you might get it wrong. Okay? It is there because you might succeed. Believe it or not. Okay? It is there because you might succeed. Most traders are scared of succeeding. Okay? I come from experience again. Okay? I'm not talking about... I'm not going to tell you what everybody else told you. Okay? Fear is not what stops you. Okay? It is actually what serves you. Okay? A lot of people try to eliminate fear. Okay? And it's because of this thinking that they have to eliminate this thing called fear. Look, as a human being, you're going to have fear. Okay? Fear is there for survival. It will keep you alive. Okay? If I have no fear about jumping in front of a train, I'm going to kill myself. Right? So it's there for a reason. Right? So, but in trading, it will serve you rather than work against you. Okay? Just all I say is try it on. Try it on. Test it for yourself. One day, okay, it hit me. Okay? It hit me. You know, it was like, one of those eureka moments. Okay? I said to myself, if most people fail because of fear, okay, and most traders fail in this business, why don't I use the thing that they fail because of? You know, might have to think about that a little bit. Okay? So, what I did is I used the fear as a trigger. Sort of like a buy and sell trigger. Okay? In a way. To me, I don't even know what fear is, okay, anymore. For me, it's a bodily sensation, okay? It feels like something, okay? I don't really think of fear the way I used to. For me, fear is a good thing, okay? For some, fear is a bad thing. Sometimes anxiety is mistaken as fear. Most traders, I think, more so experience anxiety more than fear, and actually in other areas of life as well. And anxiety actually is not a bad thing. It's actually a natural response to uncertainty. And when you're actually taking risks, whether you're in business or whether you're in trading, you're pretty certain you're going to get uncertainty. So if you have a problem with uncertainty, you're in the wrong business. I'm sorry, my friend, but that's the case. It's the truth. Accept it right now. Either embrace the risk and embrace uncertainty and embrace your fear, or move on to something else. Okay? Save yourself a lot of money and save yourself a lot of time. But if you're willing to take the task right now, embrace your risks, embrace uncertainty, embrace the fear that might come along with it. And it's not even fear. It's actually adrenaline. It's a feel-good thing. Okay? It's what makes the game fun. The traders that actually make money in this business, okay, they love the risk. They love the uncertainty. So what makes it fun. If you always knew you're going to be right, okay, it's not as much fun actually. You know, if there's that possibility that you might get it wrong, you know, but you know you might just get it right. It makes it even more fun. Okay. Anyway, just think about it a little bit different. Think out of the box. As I said, stop thinking about it the way that everybody else does, or stop thinking about it the way you have been in the past. Start thinking about it in a different way. Change your thinking, and you change your results. You change your experience. Basically, you are where you are because you're thinking. Change your thinking or stop thinking, basically. That's the choice you got. Okay? So if after you've taken the trade, and if order flow evidence tells you that you may be wrong, and then and only then you basically you exit the trade. So basically, as I said, get into a trade anyway. Even if you're not sure, get into the trade. Okay? If you can see, you know, whether you have to lose a tick or 2 ticks, doesn't matter. Get used to taking the trades and getting out of the trades when you recognize you're wrong. That is what's going to serve you in this business. Okay? So get used to it. And anybody who's not understanding what I'm talking about, go back and maybe you'll experience it one day. You know, all I hope is maybe you understand what I'm talking about. That's all I can say. So, the other thing, okay, conquering the fear of pulling the trigger. If you still cannot execute without hesitation, use the powerful process of self-inquiry and self-awareness. I do this each and every day, okay? If I am not doing what I think or believe I should be doing, or if I'm not experiencing what I believe I should be experiencing in my life, if I'm experiencing failure when I should be believing that I should be experiencing success, there's something wrong. Okay, and who's going to know the answer? Okay, not me, not Brian, you. Self-inquire, okay, become self-aware. One of the reasons I talk about meditation is because it raises your awareness levels. It raises your consciousness, okay, to a level where you're beyond the mind. You actually are looking and observing at the thinker, okay? You're observing the thinker, okay? The thing that actually destroys most people, okay? Not only in this business, in most businesses, okay? The mind itself. You observe the mind, okay? So each and every time you fail to pull the trigger, ask yourself why. Simple question. Most traders won't. Most people don't, because they won't look for the answers within. They will always look for the answers outside of themselves. But if you just simply look for the answers within and ask yourself why. Why did I do what I did? Why did I not take the trade? Was it doubt? Was it fear? You'll get the answer. Okay? What kind of doubt was it? Okay? Doubt of what? Was it doubt in my ability to trade, or doubt in my ability to follow my trading strategy, or my doubt in the actual doubt in my methodology or my strategy? Maybe someone's taught me this methodology and I'm not sure, just because they're making money with it, that I can make money with it. Is that your doubt? If so, keep trading the strategy until it becomes your belief and your truth, because then the doubt will become eliminated. Okay? So what else can you ask yourself? Okay, why didn't I pull the trigger? Maybe I had fear. Okay, what is fear? Did I feel something? I mean, fear itself is just nothing but apart from a sense of bodily sensations. Okay? You feel something. Now, did you feel something? Maybe it was fear, maybe it wasn't. Maybe it was anxiety. Maybe it was just, you know, the monkey mind. Maybe it was just some level of bullshit stopping you from succeeding, right? Doesn't matter. It's a feeling, right? Fear, anxiety, doesn't matter what you call it. Doubt, even, it doesn't matter. It's a feeling that comes from a thought, okay? Sometimes the thought comes from the feeling. Observe it. Become aware of it, okay? Does it serve you, or does it work against you? Okay? If it works against you, why don't you use it? Simple, right? So if the fear of losing is there, why is the fear there? Is it to protect you? Most of the time, fear is there because there's an uncertain outcome. Okay, most people take risks; they're not sure whether they're going to win or lose. Okay, most most human beings in general don't like the fact of losing because of social conditioning. Okay, so because from a young age we've been taught that losing is bad, taking risks is bad, etc., etc., etc. Okay, you know, in this game, losing is good. Okay, and I'll always say learn to lose profitably. Okay, learn to take risks, because if you're risk averse and you don't like taking risks, you're in the wrong business. Okay, you're actually better off not being in business at all. You're better off being an employee if you're not a risk taker. Okay, save yourself the money, save yourself the time, get back into a job. Okay, but if you're a risk taker and you can handle the fear and you're willing to make this work, there you go. Use the fear. Use what is trying to hold you back. Simple. Okay, so it's good. The thing is, your fear is there. Your unconscious mind exists for one reason. Okay, it exists to keep you alive. Okay, you're born that way. Okay, you're born that way. Your unconscious mind will do whatever it can to help you survive, not necessarily help you succeed. Okay? Your unconscious mind is there. You know, if you cut yourself, it heals you. It doesn't make you rich, right? You know, think about it. What heals you? Do you think about consciously? Oh, I need to heal myself. You cut yourself, you hurt yourself. What heals you? Your unconscious mind. Your unconscious mind's job is to heal you, to survive, to protect you, not to make you rich, right? Unless you make it that its reason, okay? You make that its reason, okay? So its highest intention is always for survival. So if you beat yourself up because of fear or doubt or losing in a trade, the reason that your unconscious mind did that and made you do the exact action or behavior you took is because of survival. It's trying to keep you alive. So don't fight it, accept it. Okay, the simplest way to deal with this is to practice techniques for clearing the mind, okay, or become more silent, and I'll call the Zen state, or reprogram the unconscious mind using techniques such as NLP to accept risk and uncertainty and make it more of an empowering belief which serves you. Taking risks and losing in trading is good rather than bad. Change your language, right? Simple stuff, but I don't want to spend too much time on this. This is way out of topic, but I had to add it in. Okay, so let's move on. Hopefully it makes a little bit of sense. Right, okay, so let's move on to trade management now. We looked at a little bit of trade execution. Okay, so now we've got to understand the importance of outstanding trade management. Probably the most important stuff, okay, in trading is your trade management, because you can have all the understanding about trade, market structure, market profile. I've seen some brilliant market profile analysts, brilliant technical analysts, and read the charts all day long, saying, buy here, sell here, but very, very crap traders. Okay, so what you want to be is a good analyst, have an idea of where buy and sellers should be, but also be a very good trader. So there's a big difference between technical analysis and trading. So make sure you understand that. There's actually a post on our blog in thetradingzone.com about that. All right, so make sure you understand that. But trade management is probably the most important thing. Okay, I laugh because it's probably the simplest thing to do. Okay, and yet it screws up most traders. Okay, so trade management is probably the most important part of the game plan. Step 5. Okay, why? Because it's basically the step that defines the outcome of any trade. Okay, you having your being the best an analyst in the world. Okay, knowing exactly what the market's going to do next, and even actually getting into the trade and having all the risk to reward in your favor. Okay, even you got into the trade, but if you don't know how to manage that trade and make it work for you, I've seen some brilliant traders. I've seen a trader that being able to pick the top and bottom of many markets each and every day, but even pulling the trigger, but taking 2 ticks rather than scaling out and managing the trade well. Okay, so it's not about analysis. You can do all the best analysis in the world and get the trade right and actually take 1 tick or 2 tick or even scratch the position. So unless you've got good trade management, again, it's useless, right? So trade management is the most important part because that's where the outcome is. Whether it's a loser or winner, the amount you lose or the amount you make in this game is determined by step 5, trade management. Okay, and it's probably the simplest thing to do. Okay, but it makes it the reason most traders make it difficult is because, again, the monkey mind jumps in, starts thinking about what I should do. Okay, maybe I should do this, maybe I shouldn't. Okay, all of this sort of stuff. Look, there's some simple rules you need to give yourself for trade management and just follow them. Okay, no questions asked. And in terms of reading order flow, there's some simple things you've got to look for. It's not difficult. Okay, in order to decide whether to stay with the trade or cut the trade. You see me do this in the trading room every day, right? So sometimes I get into a trade, I cut it and get out. Sometimes I'll say, oh, I'm going to get back in again. There's one thing that you need to realize how to do. You need to recognize how to get it in and out of trades. You might have the same trade idea, maybe sellers coming into the market or buyers coming into the market, but you might have to take that same trade 2 or 3 times before it actually comes off. You know, be prepared to exit the trade and get back in. That's what I can say. So, how will you manage the trade will define the amount of loss possible in the trade, and also, just as importantly, the amount of profit. So, no trading plan is complete without outstanding trade management. Right. Okay. So major focus points. As soon as you pull the trigger, most traders, what they will start thinking about, okay, I'm going to trade. I'm going to make some money. Dollars, dollars, dollars. Okay, flashing on front of my head. Okay. So most of you guys might want to think about this, or even just observe. As I said, just take your consciousness to a higher level and just observe your thinking. What happens when you get into a trade? Just ask yourself, self-inquiry. What do I do? Do I see dollars, or do I think about what I can potentially lose? Okay, most traders will get into the market. They're either thinking about potential profits, or they're thinking about how much they may potentially lose. Well, one thing, first of all, forget about how much you can potentially lose, and forget about how much you can potentially make, and just focus on looking for evidence to either stay with the trade, or more importantly, to cut the trade. Okay, forget about how much. Because how much is not going to be determined by you thinking about how much. It's going to be determined on how well you trade. So focus your efforts on, once you're in the trade, on trading well. Okay? Meaning focus your efforts on watching the order flow. Once you're short, are sellers continuing to hit the bid, or are buyers actually coming in against my trade? If they are, I don't care whether the setup has a 90% probability or what. If buyers are coming into my trade in the present moment, right in the now, okay, and I'm short, I'm getting out, okay? Now, it depends on also the volume, okay? It needs to be some decent volume coming in against you, okay? If I'm short, okay, or if I'm long, okay, obviously, if sellers are hitting the bids with some decent volume, which could possibly turn this market around, I'm going to get out of that trade and get back in when things look better. Yeah, good stuff, Brian. Yeah, no risk in analysis. And also, yeah, good stuff. You're seeing that this is key info. It takes you away from thinking about the gain or the loss. So yeah, one of the things you've got to do is think of, you got to, in a way, as I say, you got to be trading from a Zen state, a state of non-thinking. And some traders don't really get this until they sort of get there and actually start doing it. Sometimes I say in the trading room, I can't talk too much, or I can't think too much, otherwise I'm going to lose the ability to actually pick up my trade and manage my trade well. So sometimes I have to shut up, okay? Sometimes you have to do the same. You need to stop thinking. And I call it silent power, okay? It's the power that comes from that silence, okay? The zone of pure potential, okay? Actually, give me a minute. I'm going to give you something from one of my favorite books, okay? By Eckhart Tolle, okay? So I'm just going to give you something here. Just give me a sec. I recommend it, okay? Stillness Speaks by Eckhart Tolle, okay? Echarttole. Also the writer of Power of Now, okay? Massive believer in the power of now and being in the present moment. And I think in trading, it's pretty much where you got to be, okay? Don't focus too much on the past and what's happened. Don't focus too much on what might happen next. Just stay in the present moment right now, what's happening, okay? And go with that, okay? It's usually the focus on the past and the future that takes you away, okay, from your potential, okay? And the area of pure potential always lays in the truth. The truth is always the present moment, whether it's going to happen in the future or what, okay? If it happens in 5 minutes, okay, that 5 minutes, in 5 minutes time, okay, that's still going to be your present moment in the now. Whether it happens 3 years down the line, okay, thinking about it right now doesn't matter, okay? The fact of the matter is, what's going to become your truth is what's happening 5 years down the line in the present moment, right? So, a lot of traders and people that are in business and, set goals and stuff always sort of focus so much on the future or the past, and that's usually where the mind identification comes in, and that's where you sort of lose yourself, okay, in the past and the future, rather than remained in the present moment right now, which is where your true potential lays. Okay, so I always do a meditation in the trading room at times. We talk about paying attention to the gap. Okay, the gap between the two thoughts, the brief silent space between the words in a conversation, between the notes of a piano or a flute, okay, or the gap between the in-breath and the out-breath. When you pay attention to those gaps, awareness of something becomes just awareness. The formless dimension of pure consciousness arrives from within you and replaces identification with form. True intelligence operates silently. Stillness is where creativity and solutions to your problems are found. Okay, and that is the key thing. Okay, true intelligence operates silently. Stillness is where creativity and solutions to your problems are found. And even in the present moment, when you're trading, if you stay in the present moment and stop thinking about what may happen or what might just have happened, okay, and just stay in what is happening right now and taking that and just accepting it, okay, will move you a long way in this business. Hopefully, some of you guys understand that. Now, one of the most important things you got to do, we're going to go on a little bit more here, guys. I don't really sort of plan this. I have an idea of a guideline of timings, but I pretty much go with the flow, what's happening right now. So, that's how I live my life. I live in the present moment, what's happening right now. So, I have an idea of what's planned, in the future. But, if something's changed, something's changed. And right now, we've got to go a bit beyond timing. So let's keep going. So risk elimination. It's a major focus point in any trading game, right? Okay, in any business, risk elimination is the key. Okay, cutting costs. Okay, it's one way you might want to think about it. Okay, not only in the trading business. Okay, in any business, risk elimination is key. Okay, there's two ways to make money, right? In any business, either make more, okay, or cut your costs. And risk elimination is one thing you got total control over, cutting costs in your business, right? In trading. So the most important thing you want to think about as soon as you get into a trade, as soon as you pull the trigger, okay, that's why I have no problem pulling the trigger, because I know my focus is on reducing risk. So if I can get into a trade, I worry about being wrong in the trade once I'm in it, not before I got into it, if that makes sense. True or true? Okay, who understands what I'm talking about? Okay, most traders will think about being wrong in the trade before they've even got into the trade. Worry about being wrong in the trade once you've got in, because there's no point thinking about being wrong if you're not even in the trade. Trust me, right? There's no point, because if you're not in the trade, what is the point of even thinking about you getting it right or wrong? Because there's no way you're going to get any result about that, right? There's no result in not being in the trade, right? So you're only going to get a result if you're in the trade. So think about that, and even you don't even have to worry about it. Just deal with it. Think about it once you're in the trade. If you're not in the trade, what's the point of even thinking about it? Because it's not even your problem. Because it's somebody else's problem, the people that are actually in the trade, that are actually doing something. If you're sitting there on the sidelines just thinking about, maybe I should have taken this trade, maybe I shouldn't, you're probably in the wrong game in the first place. Okay, this is a bit hard hitting, but I'm going to be hard hitting, because if somebody's not going to, tell you like it is and the way you need to be thinking, you're less likely to react. So if I tell you, sometimes it's a bit like a slap on the face, right? But that sometimes you got to shock yourself. Okay, you got to, sometimes I like to shock people in the way they think in order to make change happen, and that's what it's all about. For me, it's all about results. Okay, and then sometimes I have to do the same to myself, right? And and I say to yourself, when you're doing, something that's not serving you, you sometimes need that wake-up call, right? And if it means thinking about something in a totally different way, do it. Okay, so most traders, as I said, are going to be thinking about. All you got to do, I'll tell you one thing. One of the most easiest things to do in this life, right, and in trading, more importantly than anything else, is to figure out what not to do. It's because what you got to do is what everybody else. What you got to do is what everybody else is not doing. Sort of makes sense when you think about the numbers in this game. Okay, 95% of traders are failing. Is it that difficult to work out that you need to be doing what they're not doing? Of course it's not. Okay, so start doing what they're not doing. Right? So how can I reduce risk or eliminate risk as possible? Okay, as soon as possible. That is what your focus should be on once you get into a trade. It's not difficult. Okay, not how much profit you can make. Okay, take this thing about dollars and making money out of the business away. Okay, stop focusing on money. Money is a byproduct of trading well. Okay, if you can't trade well, what's the point of thinking about money? Because you're not going to make it. So make your focus trading well. And how do you trade well? Become a very good risk manager. That's it. So start focusing on the things that make you money in the business and help you do it well. Right? Risk management. Simple. Okay? Profit making becomes the objective only when you have no risk in the trade. Once you have got to no risk. That's why one of the reasons why we take profits quite aggressively in our trades. And my profit targets, my first profit target is very, very close. Why? Because it adds confidence. And when your attitude change towards confidence in your ability to trade, you trade better. So my job is always doing things in order to make myself trade better, in order to make myself think more positive and actually do things from a more positive state, a positive attitude. And if I'm in that state of being, I'm going to do things much better, right? It's not complicated. It's not rocket science. It's quite common sense. But, you know, what should be common sense is probably not so common, unfortunately, right? So it's not, as I said, when you think about it and you really start doing this stuff, you think, you know, it's quite simple, okay? But sometimes all it takes is a little bit of guidance. Okay, so effective ways to minimize risk. First of all, reading order flow. Okay, a lot of traders focus on price and they just get into setups and they you know, price is going up, I'm long. So that must be a good thing to hold on to. Sometimes you might get long, price might go up and more sellers might start entering the market. If you don't see that information from the price transparency we're talking about, from the time and sales and the order flow, okay, you're not going to get that edge. So that's why we have to look at the order flow in order to get that edge to minimize risk, okay? The other thing you can look at is a counter trade setup. So say, for example, you get long, you might see some evidence, okay, to get out of the trades. Now, I talk about on the Dow, for example, okay, the Dow Jones. A negative delta of 30, 40 usually turns that market around towards the downside. A positive delta, usually 30, 40 positive delta, that's the net difference between the buying and selling volume, usually turns around that market towards the upside. Now, if you've got short and you see 30, 40 positive delta coming in counter to your short setup, the likelihood of that market going against you, okay, it doesn't matter how good your setup is, okay, it doesn't matter how much of a percentage you put behind it. At that moment, in the present moment, right now, that trade is more likely to go against you, okay, because no trade setup is 100% right, okay. So even if my trading setup and my opportunity right now is likely to go in my favor 80% of the time, if I can see evidence that that 20% is going to prove itself right now in this present moment, I'm going to cut my trade. So that's how you can start taking yourself towards the path of being 100% right, not in terms of a trade by trade basis, but from a day by day basis. And that's where I look at my results. I want to be consistent from a day by day basis. And I'll tell you one thing right now, having a losing day doesn't exist in my vocabulary anymore. Never, and I don't think it ever will, okay? And the reason is quite simple, purely because I won't let it happen, because the information I'm looking at, if I'm using the information the way I should be and using it well and trading well, I shouldn't have that down day. And if I do, something is wrong, okay? And that's when I need to take a step back. Before using the order flow, especially before using market order, there's nothing wrong with taking a losing day here and there, okay? But if you're using the order flow and you have that edge, I can honestly say that, you know, every day should be an up day, okay? A lot of traders won't believe that, and they won't understand it because they don't understand what we understand, okay? And that's why. So somebody says to me, you know, that can't be right. How can you tell me it's not right? You know, that's my experience. You know, so you know, whether you believe it or not, you know, remains down to you. But all I can say is I believe it. You know, so what you've got to do is obviously make that your experience now. Okay, so that's why we teach what we teach, because we know it works. Okay, so the other thing you can do is focus on scaling out. You know, you might, buy 3 lots, for example. Okay, now the likelihood of you getting 100 points profit target, doesn't matter if you're risking 10 points, okay, the likelihood of you hitting 100 points, okay, is not going to be as likely as you hitting 10 points profit target. Okay, doesn't matter how high probability your setup is. Okay, trust me, I'm talking from experience again. The likelihood of you hitting 10 points profit target is much greater than 100 points. Okay, most of the time. Best thing to do is hit your 10 points, move your stop to break even, then hold on to some of your position, and then take your 20 points, 30 points. And if you think it's going to go 100 points, just hold on to one position. Okay, that's all. Now, as I said, there's some days where you can actually add into the positions, which you're learning to, learn in the trading room as well. The least effective way, but yet most commonly used, is stops. Okay, most traders, when they come into our trading room, first thing they ask me, where would your stop be? And sometimes I forget that that's the mindset of most traders, right? They're always worrying about stops. One of the first things that I learned very early on in my trading is the one thing that didn't serve me as well, okay, more than anything else, was my stops. My stops got hit, okay? Now, if your stops are getting hit more often than not, what is that telling you? It's quite simple, okay? They're a problem, right? If your stops are getting hit more often than your profit targets, your stops are the problem. It doesn't take a rocket scientist to figure that out, right? So, what you need to do is focus on getting out before your stops are hit. Okay, if your stops are getting hit more often than not, the problem is your stop. Okay, or more importantly, your ability to exit before your stop is getting hit. One thing I had to do was learn to get out before my stops are getting hit. I might put in an 8-tick stop on the S&P, but it doesn't mean I'm going to accept that. That's my maximum risk. As I said, stops are insurance policy, just in case shit happens. Okay, but when you're doing things right, shit shouldn't happen that often, right? That's what I'm trying to say. You know, unfortunately in this business, for traders, shit happens quite a lot. Okay, so you got to make sure it doesn't happen for you. That's all I got to say. Okay. So effective ways to maximize profits. Okay. Firstly, what you got to do is have some predefined profit targets. Okay. In ticks. Okay. Or points. Okay. However you want to look at it. Now, for example, on the Dow, I might look at +5, +10, +30. I will already have this set up in my trading platform. I will have a stop maybe for 10 points, but it doesn't mean I'm going to let the market go against me 10 points. Okay, I might let it go against me 6 or 5 points. If I can see some evidence when it's gone against me 6 or 5 points, for me to get out, I will get out. But there's sometimes there will be cases where the market goes against me 5 or 6 points or 2 to 3 ticks, and say for example I'm short, but instead of more buying coming into the market, there may be a bit of an uptick, okay, 2 or 3 ticks, but more selling comes into the market. Okay, so in those cases, you hold on to your short, because you've got to remember, sometimes the price goes higher, but attracts more selling. Sometimes the market price goes lower off your entry and attracts more buying. So if you're long, and when the market goes against you, and it's attracting more buying, you can see that on the order flow. That's the beauty of reading the order flow. And looking at price alone won't give you that edge, right? Hopefully some of you guys are understanding what I'm talking about. Obviously, we haven't got much time, but you know, I'm trying to explain it as best I can in the time we've got. Obviously, spend some more time in the trading room. Just apply the theory of more so what I'm teaching here, and then look at the practical and the sort of information we're looking at. As I said, more so today is more about the importance of understanding the theory behind it, because that's probably the most important thing, because that's what gives you the understanding. Okay, and then the other thing you want to look at is using market, using prices, market profile, volume weighted average price levels. We buy near the first standard deviation low, cover at the volume weighted average price, cover at the first standard deviation high, those sort of things. Okay. The other thing we got to do is obviously, once we're in the trading is right, okay, we want to use a trading stop, a volatility stop, or putting your stop above the last swing high, below the last swing low. When we're long or short. Okay. So as I said, there's not a lot to it. Okay, in terms of the slides, that's it. Okay, if you've got any questions about the slides, please let me know. But hopefully you've learned something there. as I said, we're going to focus a little bit more so on the theory today, and I wanted to just push some of the things, some of it you may have heard before, okay, but just wanted to maybe express some of it in a slightly different way. Um, but as I said, we don't need to complicate it, okay? This is pretty much what you need to understand. No more, okay, to get yourself going. If you can just apply the theory behind what I've just shared today in terms of time and sales and reading the footprints, okay, and just use those setups, that's pretty much all you got to do, okay? So next sort of 10 minutes or so, maybe we have some questions and answers. Coming in here, so maybe what I'll do, I'll show you the market data charts and give you some examples. But one of the things, what you'll understand is that we apply this theory, should I say, or this mindset on a daily basis in the trading room. So, if you haven't yet sort of began to understand it, the best thing to do is really sort of understand the application of it in real time. Good stuff, Richard. As I said, some of you, just really sort of reaffirming stuff you may have learned on the coaching program or the 3-day event that we've done before. As I said, to be honest, there's not much else to it. Reading the actual footprints in real time and executing off it, comes down to sort of understanding this theory and understanding this way of thinking and seeing things more than anything else. So if you have any questions, please feel free to ask, and maybe we can look at some examples on the charts as well if you need to. So I'll hold on for a few minutes.